everybody. Hope you're all doing good. So as you are aware, recently our mother body, ICAI, they've released some case-based MCQ question in our CA final financial reporting paper. So in this video, we'll be running through those case-based MCQ question which they have released. Around 15 they have released, including RTP, MTP. In that 2-3 are repetitive. So we have around 12, I think, case-based question to be done. So in this particular session, we'll run through everything quickly for that. Okay. So one thing is these cases, they don't target any new concept. Okay. Even if we don't do this particular cases, if you know those concepts, okay, all these cases are made out of the existing concepts itself. So that means even if I don't solve this, you should be able to kind of tackle those MCQs. But nonetheless, we'll try to quickly run all the MCQs questions once again. Yeah. All right. So the first is, so some MCQ questions has been added in RTP May 2024 questions. So let's take up that. The same question of this is there in our class notes also, and it is there in ICAI study material also. Okay. So they just picked up from that and made some extra case out of this. So let's see what it is. So one company is there, they are in manufacturing aircraft, it seems. Okay, great. They are constructing some new production line. So the production line is your property, plant and equipment. So the construction started on 1st April 20X2. So obviously if you're constructing, it will take some time. So we know that for construction, you'll incur some various expenditure. That will become your DAC, directly attributable cost. They can be added. Okay, so they've given you various costs. So one quick disclaimer or point of view before you run through whole case study is, so case studies generally will be like, normally the case itself will be 1 or 2 pages. It will be little lengthier. So what I would probably suggest is have a quick look at the adjustments first. What is the requirements of the case first? Because sometimes, no sir, they will give a lot of stories. But in the requirement, hardly it will be a theory question. So that means you don't have to even bother reading the whole case study. Sometimes you can get the answer directly also. So once it pays to quickly review the questions, what exactly are they trying to ask? Okay, then probably it's better to go back to the case and review it in little more detail. Okay, all right. So first they're asking how much the amount to be capitalized. Okay, so they're asking that. Then they're asking some cash flow from operations. Okay, then they're asking some there's some customer has taken a legal case, it seems. That means that we're talking about Ind AS 37. Maybe we may have to make some provision or contingent liability. Then they're asking what will be charged to P&L. Maybe certain expenditure you cannot capitalize. Maybe they are not DAC and they have to be transferred off to P&L account. That's what they're asking. Okay, great. And then finally, they're asking how much total amount you'll capitalize it to PP account. Okay, anything else? No, that's all. So these are some requirements that they're asking. All right, great. So let's come back to the question now. Okay, first. So since you're constructing the PP, you'll incur a lot of construction expenditure. So first, cost of basic material. Basic material cost, can you add? Yes. But basic material cost ka list price is 12.5. There is a trade discount. What do we do for trade discount? Reduce it. So from 12.5, reduce 20%, you will get 10 lakh. In fact, they have already reduced it. So can I add 10 lakh? Yes, you can add 10 lakh rupees. Next, recoverable GST. Sir, if you have irrecoverable GST, meaning on GSTs, if you don't get input tax credit, such GST's amount, you can add it to the cost of PP. But however, if you are able to claim ITC, then you will not be able to add GST. So can you add this 1 crore or 1 lakh? No, you should need to ignore it. Okay. Because you don't get credit on, you are getting credit on that. Employment cost for construction. Since you're constructing a production line, you're using your own employees. So employees are necessary for constructing this. Employee cost is necessary. So that means it becomes a DAC. But keep in mind the period. So this particular staff cost, they have given it for 3 months. If you look at the next page quickly, they're saying production line took only 2 months. To construct this PP, you need only 2 months. But they have given 3 months ka employee cost. Can you add 3 months ka employee cost? No. Okay, only since the construction period is only 2 months, 2 months ka employee cost becomes DAC and you can add it. So they have given it for 3 months. So 1.2 lakh rupees is for 3 months. How much for 2 months? You need to prorate. So 1.2 lakhs into 2 divided by 3 if you do, you're going to get 1.8. So only 1.8 or 0.8 is rather your directly attributable employee cost, which can be added to the cost of PP. So but you incurred how much? 1.2. That means balance 0.4 lakh will be transferred off to P&L account. Yes. Okay. Next, other overhead costs directly related to construction. Generally, overhead cost, we transfer it to P&L account. But here they're clearly using the term, it is related to construction. So it is specifically related to construction means, yeah, this also becomes DAC. Can you add this? Yes. But sometimes they'll give you adjustment for this also. Check. The other overhead cost, which we just now discussed, incurred for 2 months. Okay, that is for 2 months only. Employee cost, they give 3 months data. But overhead cost, they are telling it is for 2 months only. Perfect. However, this overhead cost, sir, includes abnormal cost of 0.3 lakh. Abnormal cost, you cannot add it to the cost of PP. Rather, all abnormal loss will be transferred off to P&L account. But this particular data includes abnormal cost of 0.3. So can you add that? No, entire 0.9 you cannot add. From that, you need to remove the abnormal element of 0.3. So what remains? Only 0.6 remains. That can be add that much of your overhead cost you can capitalize. Balance 0.3 ka abnormal loss will be transferred off to SPL. Great. Payments to external advisors relating to construction. These are consultant fees. Yes, this is directly attributable. Can you add it? Yes, entire amount you can add. Expected dismantling and restoration cost. This only in our class purpose we used to call it as decommissioning and site restoration cost or DSR cost. Can you add a DSR cost? Yes. Full value? No. The value of this is what, sir? This 2 lakh rupees DSR cost you will not incur it now. You will incur it in future. Hence, what does Ind AS 16 say? You can add DSR cost, but only to the extent of present value. We need to find out present value. But this 2 lakh is the future value. They would have given discount factor. Check here. They've given all the blah 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 over here. The amount of 2 lakh DSR cost, sir, is the amount to be expected to incur at the end of useful life of the asset. So this 2 lakh rupees you will incur at the end of useful life of the asset, and useful life of the asset somewhere they've told here is 8 years. So this 2 lakh is expenditure which you will incur after 8 years. So it's a future value. Find out present value. They've only given discount factor to be 0.068 at 5% as a discount factor. They've only given. So 2 lakh into 0.68 you do. How much is that? 1.36. That is the present value of DSR cost which you can add. So if you add all of this, you're going to get 13.26. That is the total amount of expenditure of that you can capitalize. That's the one option. I think one of the MCQs had that, no? I think last MCQ. Compute the cost of production line to be capitalized. That is nothing but 13,26,000. Okay, that's one. All right. Next, what they can ask, I think we can target MCQ 1 also check. Which of the following items needs to be capitalized? So what and all will be capitalized? They're asking. Abnormal cost, will it be capitalized? No, it will go off to SPL. Recoverable GST? No, you cannot capitalize. Initial estimate of DSR cost? DSR cost you can add, but entire 2 lakh can you add? No, you can only capitalize to the extent of present value. And what is the present value of DSR cost? Just now we got. Present value of DSR cost is 1.36. So you can add DSR cost, but only to the extent of present value of 1.36. So D for Delhi is the right option for first MCQ. Okay. All right. Then second MCQ related to cash flow. Leave that. This we cannot add. Okay. Next, what have they asked? Yeah, I think this they've asked. Maybe MCQ 4 we can take up. Because here what happens, sir, in one case study, they will give you various paragraphs. So it's not just this, these sort of case studies will not be related to one standard. It will be a mixture of many standards. So first para may be related to Ind AS 16. Next para may be data related to Ind AS 37. Next para may be related to Ind AS 40. Like this, they will give you various standards ka data. Okay, so even MCQs also in one order way they will not give. Like first MCQ may be related to Ind AS 16. Second MCQ may be related to some other standard. Again, fifth MCQ again may be related to Ind AS 16. So like this, they'll go on juggling. Okay, so you need to just work it out. Okay, and all these are rough works. The working notes that you're preparing will not be corrected. You'll just need to select the answer and the option that you have selected. If it is right, you'll be given the full marks. So workings and all will not carry any marks over here. So you can work it out in the way you feel. So if you don't want to write anything, if you want to solve everything in calculator, that is also acceptable. So how you arrive the answer is not really important over here. What is really important is whether did you get the right answer is one. Okay. So let's look at this. Calculate the total amount to be charged to P&L account with respect to the production line and the balance of provision for dismantling cost. We know that, sir. What is the journal entry we pass for DSR cost? So the journal entry we pass is PP account debit to provision for DSR. This is what we pass. Correct. Initially, when you're capitalizing DSR cost, this is the entry we pass. But provision will be capitalized only to the extent of present value. But it will be settled at a future value. The difference between this present value and future value is nothing but your time value of money ka interest charges. That means we need to prepare that amortization cost table, ACM table you need to prepare. That's what I prepared over here. Okay. So what is provision ka opening balance? So the present value of the DSR cost was 1.36. So the opening balance of, one second. Where is it? Here, the opening balance of provision for DSR is 1.36. The finance charges at 5%. Discount factor we read there, it was 5%. So calculate 5% of 1.36, it will be 0.06. This is your finance charges. There is no payment. Payment will come only after 8 years. We are in the first year now. So closing balance will become 1.42. That is what they are asking. What is provision for DSR account ka closing balance, which is 1.42. Which option has 1.42? Option number C. So that's the right option. Okay. That is what they asked. And they also asked what and all will be transferred off to P&L account. So there are many things which will be transferred off to P&L account. What is that? Sir, to construct this production line, 3 months salary you paid, but in that only 2 months you can capitalize. 1 month will be transferred off to P&L. So what is that 1 month? 0.8. We already wrote. Then there is an abnormal loss of 0.3 that should be transferred to P&L account. That is one. Okay. Then there is a finance charges. From this DSR, you're getting finance charges. Even that will also be transferred to P&L account. Is that okay? And then since this is a production line will also get depreciated. So depreciation also you need to calculate. So how do you depreciate? I think for that they have given additional data. So let's run through this. Here, what is that? One more data I think is related to that. Now, production facility was completed within 2 months. Okay. So April, you started the construction in April. You started the construction in 1st April and the construction is over by 31st May. That means in the current year, you will charge depreciation only for 10 months. That is one. Okay. Next, they are also telling one more data. Once again, I'll bring your attention to that. What are they saying is here, which is that I think they've given there. I think I had seen some 1 second. One more data relating to inspection charges was there. Where is that? That's what I need to just quickly review that. 1 minute. Because it is important. Here, sir. Sorry, this only, this para only. Okay. Since we are juggling in the moment of time, I'm just going through only relevant data with you. Okay. So check this. 4 years after being brought into use, once this production line is used for 4 more years, the production line will require major overall charges. We have discussed this. If you are doing any major overall or inspection charges, what do you have to do? You have to depreciate. Like here, sir. Normally, what is the life of this production line? The useful life of the production line is 8 years. But in this production line PP, there is one more part called major inspection charges. That has to be depreciated only over 4 years. This only we studied it as component accounting. If different components or different parts of PP have different useful life, they have to be depreciated separately. So what is the overall cost of PP? The total cost of PP we got it is 13.26. In that, how much is the overall charges? They're saying overall charges is 3 lakh. So in this 13.36, 3 lakh is towards the inspection charges or overall charges. And this 3 lakh has to be depreciated over 4 years. The balance has to be depreciated over the remaining normal useful life of 8 years, like this. So parts of PP don't have same useful life. They have different useful life. So depreciation also has to be calculated on a different scale only. So on this 3 lakh, you will depreciate over 4 years. So how do you calculate depre? 3 lakh minus there is no residual value, 0, divided by useful life, which is 4 years. So if you do that, you're going to get 1 year depreciation. But in the current year, the this particular asset was ready to use only from 31st May. I mean, in the current year, you'll only charge depreciation for 10 months. So calculate 10 months depreciation on this inspection charges, you'll get 0.625. On the other part, which is for 10.26, depreciated, or you will calculate depreciation over a period of 8 years. But current year, only 10 months depreciation, that will give you 1.0687. So total depre will be 1.69. This depreciation charges also will be transferred off to P&L account. That's what they asked. Okay, that is what we were about to solve that MCQ question. So one more will go up to P&L account, that is depreciation. To sum it up, okay, what and all will go to P&L? 1 month employee cost, abnormal loss, finance charges on DSR, and depreciation. So if you add it, you're going to get 2.85. But one mistake study material has done it over here is they have not considered these two data in option. Okay, I don't know why. Maybe it's a typo, by mistake it is. They only transferred, in the option, they only transferred finance charges and depreciation. If you add finance charges and depreciation, you're going to get 1.75. Hence, that is a selection. That's the option they've selected. Okay, so it's a mistake only because even these two costs should go to P&L account. But unfortunately, they have not included that. Maybe it's a typo, they'll correct it, it's fine. But, or even if it is so also, sir, when you are answering MCQ question, even if the answer is not the same, the closest answer you will select. Like one option, they asked what, sir? Two things they asked in this MCQ. What is provision for DSR ka closing balance and how much expenditure will be transferred to P&L? What is provision for DSR ka closing balance? 1.42. Does any option have 1.42? No, only one option has, which is what? C for Chennai. So obviously, invariably, you have to select option number C only. Okay, so like that. Fine. So it's fine because this is the closest answer. Because in my opinion, even these two should be transferred to P&L only. So option should have been 2.85 and 1.42. But still, even if you ignore that also, still you will be able to decode the right answer. It's fine. Okay, that is one. That is with respect to your production line ka. Next data they have given us. Some FA Limited provides some consultancy service to some customers we are giving. Okay, some customer is probably not happy. The system has, we have given some consultancy service. Okay, so I'll just give you a gist of it. Okay, so because the point of view is to just cover everything quickly. Right? We have given some service to the employee, to the customer, and customer is not happy. So he has filed a legal case against us. So we filed a legal case means this is a data relating to Ind AS 37. Yes. So we know what is that. If the obligation is probable, you make provision. Otherwise, if it's possible, you disclose contingent liability. If the obligation is remote, then nothing is required. Yes or no? So here, let's see what happens. The customer is claiming a damages for 1.6 lakh rupees. So the question is, should we make provision or disclose contingent liability or ignore? That's all is a fund of this particular case study. The legal department of the company is considering that there is a 25% chance that the claim will be successfully defended. Successfully defended means we will win the case. What is the percentage chance of winning? They are saying, our lawyers are saying there is a 25% chance that we will win the case. That means there is 75% chance of losing the case. So outflow will happen only when you lose the case. There is a 75% chance that you lose the case, means obligation is probable. And for all probable obligations, what do you do, sir? You create provision. Provision for the best estimated settlement amount. Here they've not given any best estimate. So we'll take how much has the customer filed the case for? 1.6. So you'll make the provision for 1.6 itself. So that is the answer. Okay. That is one of the options that they had asked. In point number 3, how much provision we need to create or what we need to do. So B for Bengaluru is the right option here because we need to make provision for 1.6 lakh rupees. So nothing new. Okay. Whatever we have studied only, they'll give it in a different format and ask the same thing. Okay. So aramse try to answer, but not so aramse also. You should be able to solve it within the stipulated time also. So no extra preparation is really required for these MCQ questions. It is something which you have learned only coming in another format. That's all. Okay. Then they asked, I thought also they asked cash flow from operation that they have given next data. I think we read the whole day, first para, second para, all this we have read. Now let's go to the third para. They have given 3 para in the case studies. F Limited, the company, has an associate company, Flynet Limited. So some information they have given. So using this information, basically we need to find out cash flow from operating activity. That's all. Not full. Okay, 1 second. Not full data. You just need to find cash flow from operating activity. So how do you that? How do you get that? They've given net profit after tax. That is nothing but your PAT. Okay. Next, decrease in accounts receivables. You already know this, sir. Working capital changes. What is that? Increase in current assets means minus. Decrease in current assets means plus. Increase in current liability means plus. Decrease in current liability means minus. Logic of all this I had explained it in regular class. So now I'll not go into all that. So we'll just have to use this and accordingly do it. So decrease in accounts receivable is a correct. So there is a decrease in current assets. So what we have to do? Add it up. Depreciation. Depreciation is a non-cash expenditure. So add it up. Yes. Increase in inventory. Increase in current assets means minus. Increase in accounts payable. So increase in current liability means add. Decrease in wages payable. Wages payable is an outstanding expense. So it's a liability. So decrease in our current liability means minus. Tax charge for the year. We don't want tax charge. When there is a tax charge, P&L balance will reduce. Under indirect method, this we are solving under indirect method. Under indirect method, we get cash flow from operating activity using profits. Okay. So due to this tax charge, your P&L balance is reduced. If your P&L balance is reduced, your operating cash flow is also reduced. Because under indirect method, from profit only we derive operating cash flow. This is not tax paid. This is tax charge. So P&L is reduced. Okay. So hence we add back. Because we want tax paid, we don't want tax charge. And then profit from the sale of land. Profit from the sale of land has been transferred to P&L account. So P&L balance has increased. But sale of land is not an operating activity. It is an investing activity. But it has increased your profit means it has also indirectly increased your operating cash flow. Hence what to do? Minus it. So deduct all this, you're going to get 170. So that is the right answer. Before Bengaluru, 170 lakh is cash flow from operations. Okay. Anything else? No. I think all the questions relating to this case study we have solved. Nothing new, not even one component. In fact, in all the case studies that we have solved, I mean that they have added up now, 12 case studies which I mentioned. No new concept. Everything has just been asked in a different format. That's all. Okay, so let's run through the second case study in our RTP. So I'll just give you the gist and quickly we'll sum it up. Okay, sir, one company is there, HS Limited. They have, with an intention to expand HSL Limited, they've entered into a share purchase agreement. Share purchase agreement, they're calling it as SPA, with shareholders of FM Limited. So they've made a share purchase agreement with some shareholders that they'll buy. They'll buy 30% stake as on 1st June. Okay, great. At a price of 30. As per the terms of SPA, HSL, our company, has an option to purchase an additional 25% in FM Limited. Okay, stop there. So currently, how many shares we have purchased? 30%. Okay, not only, so with 30% we don't get control, it becomes an associate company wala relationship. But not only 30%, we also have an option to purchase another 25%. When? On or before 15th June. In about 15 days more, we have an option to purchase another 25% stake. This we call it as what, sir? Potential ordinary shares, or POS. So we have studied the same question is there in our class notes also, in our study material also, ICAI study material also. So what did we say? Sir, if POS is currently exercisable, then even POS can be considered to find out the date of control. Okay, so to find out, meaning even this also can be added provided it is currently exercisable. Read the data. So you can exercises when? In 15 days. So you can exercise that now itself or on or before 15th June. So we have 15 days time to buy another 25% stake. Okay, similarly, the selling shareholders has an option to sell. You have an option to buy means they're saying other person also, the shareholder from whom you are buying, he also has an option to sell is what they're saying. The decision on relevant activities are made at the AGM, and resolution in AGM is passed when 50% voting is cast. And to conduct an AGM, you need to give at least 21 days notice. Okay, so before 21 days only. Yes, you have already, on 1st June, we have 30%. In about 15 days more, we will get 25%. So that means on or before the AGM date, we will have 25%. So basically this question was, what is the date of control? What is the date of control? Don't take it as 15th June. If these POS instruments are currently exercisable, then on which day you have an option to buy this 25% stake? From 1st June only you have an option. So here 1st June 20x2 will be taken as a date of control for consolidation purpose. So this will not be treated as subsidiary company. This will not be treated as an associate company. This will be treated as the subsidiary company itself. That's all is a funda over here. So the date of control will be 1st June itself. So from 1st June onwards, you got the control. That's all is the funda over this question. That's a theory question. Yeah. Second is HSL Limited has issued compulsorily convertible debentures. So compulsorily convertible debentures will be a compound financial instrument. Why, sir? So on debentures, you have to pay interest. So you have an obligation to pay interest. So that portion, the portion to pay interest is a financial liability. Since it's a compulsorily convertible debentures, principal amount of debentures, you will not repay in cash, but you will rather pay equity shares. Okay, so that means that portion, the principal portion will be converted into equity shares, means that represents the equity element. So this particular instrument has both equity as well as financial liability. So it's a compound financial instrument. Okay, that wala drink. So the total value of this instrument is 100 lakh. Okay, these instruments are convertible into 5 shares at the end of 4th year. So obviously fixed to fixed test is also getting passed. Because if you want to classify it as equity, we have a rule. The fixed to fixed test has to be passed, meaning the number of shares and the total consideration should be fixed. Here it is so. That's the reason. All right. Interest is payable at 6%. Great. H Limited has recognized the liability component of 2079-063. Such nice problem. So we know that this is a CFI. So entire 100 lakh, you can't book it as financial liability. You have to split. That split up, they only given. So out of 100 lakh, financial liability portion is this. So balance portion will be accounted as equity portion of compound financial instrument. Okay. That is what. Next, they also incurred 2 lakh rupees in connection with the issue of the instrument. That 2 lakh rupees is your transaction cost. So basically this question is revolving around transaction cost. When I did marathon also, we took the same question with the transaction cost. So in case of compound financial instrument, what should we do for transaction cost? Transaction cost entirely cannot be considered only for financial liability. The transaction cost has to be split. Since the instrument has financial liability and equity portion, even transaction cost has to be added for, or transaction cost has to be split, or it has to be considered for both financial liability and equity. So basically 2 lakh transaction cost will be allocated to financial liability and equity in their respective ratio. This is the 2079 and 79 ratio. So in this ratio, 2 lakh will be a portion. So how much transaction cost will be allocated to financial liability? This much. How much for equity? The balancing figure. That is what is the question all about. So what will you do for transaction cost? You already know the option. Check. The transaction cost of 2 lakh will be split between equity and, or will be allocated among equity and financial liability in their carrying amount ratio. That's what a theory question. Everything they had only done. Okay. In fact, without even solving also this particular case study, you can answer. Because for other options, no, there is no apportionment option at all. All other options, if you see, they're never talking. We know that whenever there is a, normally, how do you allocate? In carrying amount ratio. Right? So when you allocate, obviously the value you don't know. Only when you allocate only, you will get to know how much transaction cost got allocated to financial liability, how much transaction cost got allocated to equity. But if you just check other option is entirely saying transfer it to P&L, transfer entire 2 lakh from equity. So other option or recognize 2 lakh as interest cost. So all other 3 options are not even talking about allocation. Only one option is talking about allocation. That is option number C. So without even reading the whole data, you can tick off the answer. Okay, even if you don't know the value. So because certain MCQ questions will be very, very straightforward. So don't waste too much time. That's the reason first always read the requirement, because some will be very, very straightforward. Okay, right? All right, that is one. Next, HSL Limited, the company, they have acquired 40% stake in NM Limited. So with 40%, you are an associate. You get the associate relationship. So on 1st January, great, for 8 lakh rupees. Awesome. The classify the investment in NM Limited as an associate. Great. On 1st January, the carrying amount and the fair value of plant and equipment of the associate company NM Limited is 3 lakh and 5 lakh respectively. So they have given carrying amount and fair value. So we have already done such questions in our associate company. All right. Normally in associate consolidation, we don't show the assets and liabilities of associate company, but we show our investment. So Sharni, should we consider fair value adjustment? Yes. We should consider fair value adjustment, not to show the asset, but due to that fair value adjustments, you will get some extra depreciation or you have to reverse the depreciation. That depreciation effect has to be considered when you're doing equity method of consolidation as per associate. Okay. So here, what is the carrying amount of PP? 3 lakh, but fair value is 5 lakh. That means there is a fair value adjustment of 2 lakh rupees. This 2 lakh rupees fair value you cannot show because associate company ka assets you don't show. But since you are increasing the asset by 2 lakh, due to this fair value adjustment, you will get extra depreciation. So check what is the remaining useful life. Remaining useful life of the asset is 5 years. Okay, so that means this 2 lakh has to be depreciated over how many years? 5 years. But hang on. When did you acquire the shares? On 1st January, and our year is ending on 31st March. So that means current year you will charge whole year depreciation. No. You got the significant influence only for 3 months in the current year. That means in the current year, from January to March, only 3 months you will depreciate. So 2 lakh rupees, which is your fair value adjustment, that you will have to depreciate over 5 years. But in the current year, you will only depreciate from January, February, March. That is for 3 months. So excess depreciation is 10,000. Entire excess depreciation will you consider? No. If it was subsidiary consolidation, entire excess depreciation we would have considered. But this is only associate. In associate company, what do? Our share of excess depreciation, only our parents' share of or investors' share of the excess depreciation only will be considered. So how much does the investor own over here? 40%. So 10,000 ka 40% if you calculate, that will be only 4,000. Only that much will be considered for equity method of consolidation for associate. Only as far as equity method is concerned, we don't take the total data, we only take investor ka share. In this case, investors ka share is 40%. Okay. Next, what are they asking? From and the company also, this associate company, they also generated a profit of 50,000. So what is the requirement? If you just check the requirement, I think in one of the question they asked, what is the carrying amount of investment? Associate company, what is the carrying amount of the investment at the year end? So how do you get the carrying amount of the investment? How much did you buy it for? 8 lakh, right? Then is there any additional depreciation? Yes. Due to this fair value adjustment, you got investor share of additional depreciation of 4,000, which you need to reduce it. Then did associate company make any profit? Yes, associate company reported a profit of 50,000. Entire associate ka profit investor will get, or only investors ka share? Only investors ka share, which is what? 40%. So 50,000 ka 40% you calculate, that will be 20,000. So add on this. No other adjustment like dividend and all not given. So even that also could be added up. I had already given. One trick of finding the carrying amount of investment at year end is match investment with associate company ka performance. If associate company makes profit, investment balance will increase. If associate company reports loss, investment balance will reduce. If associate company declares dividend, if they declare or pay the dividend, then net assets will reduce. So if net asset reduces of associate company, our investment balance also will reduce. And if there is any unrealized profit, that also you should consider, but not entire unrealized profit, but only parents' share or investors' share. All that adjustment is not there. Only one or two adjustment is given over here. So the final answer is 8,16,000. That's what is selected over here. Okay. Yeah. Anything else they have given? Yeah. Okay. Next case study, we'll run through this. While selling a car, maybe we are car dealers, so we are selling a car, a trade discount of 1% on sale price is given. Okay. What do we do for trade discount? Reduce it from the invoice price. HSL provides a credit period of 7 days to its customer. However, if they paid upfront, then S Limited or HSL Limited will give an additional discount of 2%. Okay. If you pay upfront, then you'll get the discount there. Okay. HSL, the company, they also provide a voucher worth 500 rupees with a validity of 1 year, which can be used at an apparel store. So we have already done such questions. This is an Ind AS 115 treatment. We have already done such questions in Ind AS 115. So voucher, no, whenever you have a discount voucher wala problem, the discount voucher is a separate, or it represents a separate performance obligation. So you cannot recognize the revenue of this 500 rupees is the voucher amount. No, you cannot recognize the revenue of 500 rupees on this voucher now only, because it represents a separate performance obligation. A transaction price should be allocated to this separate performance obligation, and revenue on this voucher should only be recognized when the customer utilizes this voucher in future, or when the voucher expires. Here the voucher is expiring at the end of first year. So you'll have to wait for 1 year. Okay, or till the time customer utilizes it. Right now, you cannot recognize the revenue. So you need to select that option. So select which option here, check. Trade discount, cash discount, and value of voucher should be reduced from the revenue. Okay, because you cannot recognize the revenue relating to that extent. Revenue relating to voucher and all, you can recognize it only in the future. That's the reason D for Delhi happens to be the right option over here. Okay, so this we answered, this we answered. I think, yeah, transaction cost we already answered. Anything else? Yeah, this is the date of control. Okay, or maybe one more question was there. I think, yeah, the date of control is this question. We already told you the date of control is 1st June. We answered that. Okay, one more question is there. Let's run through this. With more acquisition at the end of the year, HSL has investment in 2 subsidiaries. This is a proper question. It's not relating to case study. They've just given the data here only. So they're saying now we have 2 subsidiaries, we have 3 associates and 1 joint venture. We have acquired more companies. So 2 subsidiary, 3 associate and 1 joint venture we have. Which of the following statement is correct with respect to accounting of investment in SFS, separate financial statement? They're not talking about consolidated financial statement. They're talking about SFS. So we have Ind AS 27, which talks about separate financial statement. What does Ind AS 27 say? If you have investment in associate, subsidiary or joint venture, in separate financial statements, either you can value it at cost or you can value it as per Ind AS 109. Ind AS 109 gives you 2 options, FVTPL or irrevocable option of FVT OCA. So that's what we need to select. But one catch over here is, sir, if you have 2 subsidiaries, right? If you have 2 subsidiaries, what Ind AS 27 says is, for both the subsidiaries, either you can go for cost model or Ind AS 109 model. If you have 2 subsidiaries, for both the subsidiary ka investment, both investment in subsidiary has to be either valued under cost or under Ind AS 109. Like for one investment in subsidiary, I'll go for cost model. For one, I will go for Ind AS 109 option. That is not acceptable. It's same like revaluation model. We have studied in Ind AS 16, same funda. Okay, there we said revaluation has to be done on class by class basis. Here also the same funda. If you have 2 subsidiaries, for both the subsidiary, either cost or Ind AS 109. Similarly, if you have 3 associates company, for all the 3 associates, either go for cost or for all the 3 associates, go for Ind AS 109. For one associate, I'll apply cost. For another 2, I'll apply Ind AS 109. Like this, the partiality within the associate, you cannot do it. Okay, that is the option. Hence, you'll have to select that. HSL, check this. HSL has an option to measure all such investment either at cost or in accordance with Ind AS 109. Correct. But however, the option is available for each investment, for each category of investment. This choice or cost of Ind AS 109, no, that valuation is not on an individual basis. It's based on category basis. Okay. So yes, so the option is available for each category of investment separately. So hence D for Delhi is the right option in this particular case study. Okay. So theory based question. So with this 2 questions relating to the RTPs we have done. So I think we'll go for one more. This particular question, sir, is a case study relating to Ind AS 7. Same question, I've done it in our class, regular class as well. Also this time, if you have not our regular student, I've done a marathon. You can check the marathon. In the marathon, I've covered the same question, full question. Ditto question with the ditto value. Based on that only, they've asked MCQ. So you can take care of that. Yeah, I'll not be doing it. It's a repetitive exercise. No point in wasting too much time in that. Yes. All right. So let's go for the next case study then. Joy Limited. Okay. Joy Limited wishes to calculate tax base. The moment they talk about tax base, obviously it is an Ind AS 12 related MCQs. So one again, what we'll do is before we read the whole case study, let's quickly run through the question requirement. One, they're asking you tax base of PP, and then they're asking you deferred tax on PP, either DTA or DTL. So PP ka they're asking. Then tax base of development cost, deferred tax of development cost, then tax base of trade investment, deferred tax of trade investment. 3 things they're asking. Okay, one is with respect to PP, product development cost and trade investment. Okay, so let's keep that in mind. So PP ka carrying amount is this, and product development ka carrying amount is 60,000 and trade investment ka is 2,08,000. So only these 3 ka related data they have given. So let's now dive into the additional information. Depreciation expense for 20X4X5. Currently we are in which year, sir? These are the balance sheet as on 31st March 20X5. So current year will begin on 1st April 20X4 and it will end on 31st March 20X5. That's the current year we're talking about. So depreciation for the current year, according to tax laws, is 2,06,000. Perfect. Because they're asking tax base. No. So they're asking tax base means what? What is the carrying amount from the tax record perspective? So for tax record, you'll only consider depreciation as per tax. You'll not consider depreciation as per accounts. So tax ka depreciation they've given for the current year is 206. Okay, accounting depreciation, however, is 1,70,000. That's for the accounts and that's for the accounting. But for however to calculate taxable profit, we need to consider tax wala depreciation. Okay, the cost of PP. So whenever they say cost, it means original cost. So originally this PP was purchased for 16 lakh. Perfect. The Joy Limited, the company, has deducted an expense of 4,16,000 in its tax return prior to financial year 20X4X5. So the deducted expense of 4,16,000 in tax return means what are they telling? What is the expense relating to this asset? Depreciation. So they're saying before current year before current year, total depreciation charged by the company in their tax return is 4,16,000. Basically, this is accumulated depreciation till the current year. Okay, till the current year, 4,16,000 has been charged. With this aram, so you can get tax base. No, originally you purchased for 16 lakh. Till last year you have depreciated 4,16,000. So what is the current year depreciation as per tax law? 2,06,000. So deduct that, you will get the tax base. That is the option. That is a solution to your MCQ 1. All right. Now carrying amount you already know. What is the carrying amount? Carrying amount of this PP is 12 lakh rupees. We know the equation. What is the equation for deferred tax asset or deferred tax liability? I told, remember one. I proved it to you with logic. Now I'll not go into all that stuff. So when you're talking from the asset, if carrying amount of the asset, if it is greater than tax base, only one you need to remember, that's all. All other things will fall in place. If carrying amount of asset, if it is greater than tax base, then you need to create deferred tax liability. You'll create deferred tax liability on the difference? No, you'll take the difference and multiply it by the tax rate. The difference we call it as, since you're creating deferred tax liability, the difference we call it as taxable timing difference. So if carrying amount is greater than tax base, you will get taxable timing difference, and on this taxable timing difference, you need to create deferred tax liability. Okay, so basically take the difference and multiply by the tax rate. Here the difference is 2,22,000, that is taxable timing difference, and the tax rate is given in the question to be 32%. So take the taxable timing difference, multiply 32%, you will get deferred tax liability of 71,040. Okay, so that is the option. So they asked the tax base, which is this. They asked deferred tax liability, which is that. So we have to select that option. Question 1 ka answer is what, sir? They asked the tax base. Tax base is 978. What we got, and deferred tax liability we got 71,040. That is the right option. That's all. This is with respect to PP. Next, we'll go with respect to the development cost. So you are incurring some development cost. This is intangible asset under development. We've already studied. As per Ind AS 38, development cost can you capitalize? Yes, provided TIFRC is satisfied. Maybe the condition is satisfied, so they have capitalized. So in 20x1, x2, keep the mind in the data given. 20x1, x2. So currently we are in x4, x5. So x1, x2 means x1, x2 1 year, x2, x3, x3, x4, x4, x5. 4 years we already passed. Okay. So you incurred the development expenditure 4 years before. So totally how much you spent? 1 lakh rupees. These costs are recognized as an asset and amortized over a period of 10 years. So since the condition is satisfied, you have capitalized it and you're depreciating it over 10 years. So that means what is the carrying amount? On 1st April 20x1, the carrying amount of this intangible asset is 1 lakh. You're depreciating this over 10 years. So currently 4 years is already passed. So 1 lakh divided by 10 if you do, you're going to get 1 year ka depreciation. Multiply by 4 to get 4 year ka depreciation. So carrying amount of this particular intangible asset is how much? 60,000. However, for tax purpose, Joy Limited deducted full development cost in X1, X2 only. In tax pay, you got deduction that year itself. That means what is the tax base? Fully you already claimed. So the tax base is 0 in this particular case. So again, the same equation, carrying amount is great. This is an asset, intangible asset. So carrying amount is greater than tax base. So you will create taxable timing difference. On taxable timing difference, you have to calculate deferred tax liability. Okay, that will be 19,200. Again, they ask tax base and DTL. So 0 and 19,200 DTL is the right option. That's all. Okay. So very, very straightforward question. Nothing new there. Yes. All right. Next, trade investment were acquired in 20x4, x3, x4 last year at a cost of 2,30,000. Okay, great. That is a cost of investment. These investments are classified as fair value through P&L account. So on this investment, we are following FVTPL method and thus recognized at fair value. So fair value adjustments are not tax deductible. We have fair value adjustments as per, FVTPL and all is as per Ind AS 109 accounting treatment. Okay. All this is not there in tax record. So that means what is the tax base? As far as the tax record is concerned, the tax base is 2,30,000 because you bought it for 2,30,000. So tax base is 2,30,000. But what is the carrying amount? Since you're following FVTPL method, the carrying amount need not be 230. It could be more or it could be less. So they've not given, they've given balance sheet. Check. What is the trade investment balance sheet data? 2,08,000. So carrying amount of that investment is 2,08,000. Tax base is the original cost, which is 2,30,000. So this is still an asset, but carrying amount is lesser than tax base. It is not greater than tax base. So if carrying amount is lesser than tax base, we have to create DTA. The difference we call it as deductible timing difference or DTD, deductible timing difference. So these two difference is 22,000. On this deductible timing difference, you have to create a deferred tax asset at the rate of 32%, which is 7040. That is the requirement. I think next. Tax base of trade investment they asked, which is original cost of 230. And they also asked what you will create. You will create DTA or DTL. You will have to create DTA to the extent of 7040. Last question, they're asking what is the net DTA or DTL you will create. So few components give you DTL, two components give you deferred tax liability, one component give you deferred tax asset. Normally we don't show both DTA and DTL separately, we net them. So when you net off, the net deferred tax liability is 83,200. That's the right option. That's all. Okay. Yes. All right, sir. Next one then. That's all. Simple ones. Yeah. All right. Next question is also based on Ind AS 12 itself. Just one second. Marvel Limited, they wish to calculate tax base. Again, same. So what we'll do is quickly we'll run through the requirements. You need to calculate tax base of government grant and defer tax relating to government grant. And then they're asking tax base of liability, DTA, DTL on liability. Then they're asking you something on healthcare benefits. Okay, same thing. So it's the same, pretty much similar setup. So three things they're asking. One is the government grant. Another one is the some product warranty cost. Another one is healthcare benefit. So these are the respective carrying amounts. So whatever we have boxed now is the carrying amount. Now let's come to the adjustments. Government grants are not taxable. They are tax-free income, it seems. Okay. The government grants received in 20X4X5 is appearing in balance sheet. Okay. So normally I think on this particular case study, I slightly disagree with the solution given. I'll tell my opinion. But for example, follow what I say our mother body has done because we cannot override. So this we have already studied. If you have any exempt income, we call that as a permanent difference. Although Ind AS 12 does not use the word permanent difference, but the treatment is pretty much the same. Okay. If it is not taxable, what do? Whenever a particular asset or particular liability, if it is not, particular asset, if it is not if taxable at all or not subject to tax, then what do? Make the carrying amount and tax basis same. Right? If it's a permanent difference, the one quick fix is you should not create DTA, DTL on such permanent difference. One quick fix to do this is make the carrying amount and tax base to be same. So here, what is the carrying amount of government grant? 40,000. So tax base also should be ideally 40,000 in my opinion. Okay, but our mother body is saying tax base is 0. But they're telling the right answer. We should not create any DTA, DTL on this. That's right. But in my opinion, the answer should have been B, but they have given it as A. So I cannot override it because that is right in my opinion. But for exams, follow this only. We can't override. That's the reason. All right, next. Marvel made a further provision for warranty of 5,000. We don't want further provision. DTA, DTL is not created on P&L items now. DTA, DTL is created keeping balance sheet in mind. So we want in that balance sheet, what is asset ka carrying amount and what is that asset ka tax base? What is the liability ka carrying amount and what is its tax base? What is the liability of product warranty cost? In balance sheet, you're totally showing 16,000. So basically carrying amount of that liability is what's here? 16,000 rupees. Yes. Okay, next what? Such provision for warranty cost are not tax deductible. Not tax deductible, Allah. Don't stop there. If you just stop here, not tax deductible, then it becomes a permanent difference. This is not that. Okay. Warranty costs are not tax deductible until the claims are paid. So in Income Tax Act, no, you will get deduction only when you settle. In accounts, we make provision. When you make provision, P&L balance automatically will reduce. Okay. Meaning you will be able to claim that deduction in P&L. But in tax, you will get the deduction not when you make the provision, when you settle the provision. So this is done on a payment basis. But we have booked it on an accrual basis. So it's a difference. Okay. It's a temporary difference only. Okay. So that means what is the tax base? You will not get the deduction now. So you can't pass any entry in tax record now. So the tax base of this particular account is what, sir? This particular liability ka tax base, as per tax record, this liability ka balance is 0. Because you will get deduction only when you settle. Yes. So tax base is 0. So this is liability ka. So liability ka carrying amount, it is greater than tax base. Sir, if asset ka carrying amount, if it is greater than tax base, then you will create deferred tax liability. Here it's for a liability. So if liability ka carrying amount, if it is greater than tax base, you will create deferred tax asset. Okay. So if they ask you the difference on what you will create deferred tax asset, on all deductible timing difference, on all DTD deductible timing difference, you will create deferred tax asset. So 16,000 minus 0 is your DTD amount. On that, you need to create deferred tax asset of this much value. Okay. So that is your answer, right? So I don't know what they asked. I think they asked tax base. Tax base is 0. Then we need to create DTA of 5120. That's the answer for question number 4. All right. Next one. Another one. One company. The company has introduced some health case benefits for employees. So this is talking about Ind AS 19 employee benefits ka drama. The expenses are allowable as deduction only when the benefits are paid. Okay. So in tax, you will get you'll claim deduction only in the year of payment. But in accounting, we know as and when the employee serves, obligation gets created, you have to go on booking amount. You have done projected unit credit method or all. Okay. All right. But in Ind AS 19, such liability is recognized when the employee provides service. So obviously, there is a difference. It's not permanent difference. Okay. It's a temporary difference because in accounting, as and when the employee services, you are booking the expense. But as per income tax, you'll get that expense deduction. You'll be able to claim deduction only when you settle it. So it's a temporary difference. So what is the carrying amount of that healthcare benefits in your books? 70,000. So there's a liability. So carrying amount of liability is 70,000. Tax may currently you will not get deduction. You will only get deduction when you settle. So currently tax may you can't pass any journal entry. So you can't do any account. You can't do any entry. So the tax base is nil. Okay, because you'll get the deduction only in future. So that means the tax base is 0. So same thing, carrying amount of liability, this is carrying amount of liability. If it is greater than tax base, then we have to create DTA, but the difference will be known as deductible timing difference. So they asked, I think again, tax base. No, I think here they did not ask tax base. So watch out. See, in the last few questions, the order was, they were asking tax base and DTA. Okay, now they've changed the order. Check in question number 5, what did they ask? Determine the temporary difference. They're not asking tax base, they're asking the difference amount. So what is the difference amount here? The difference amount is 70,000. Deductible timing difference. I think they're not asking you to find out whether it is taxable or deductible, but they only ask the difference. So the difference amount is 70,000. On that, you have to create a DTA of 22,400 rupees. That's all. Okay. A simple case study. We have done a lot more complex question in our Ind AS 12 and all that stuff. This is very, very chin to question. For your standard, nothing. Correct? No? Yeah. All right. So we have one more question relating to Ind AS 12 itself. So again, let's read the requirement. So what is the requirement is, you need to find out the tax base and you need to find out DTA or DTL again for this. Okay, same. For the other one also same. One, you need to create tax base of inventory and DTA DTL on inventory. One is on the inventory, another one is on trade receivable. So let's underline that. Inventory. Where is inventory? Inventory ka carrying amount is 3,04,000. Trade receivable ka carrying amount is 6,26,000. Okay. We need to find out the tax base because that's a requirement. Now they have given some additional information. Let's run through that. I think similar question is we have solved in class also. Yeah. But not same value, but similar one. Maybe name and value change is different. But yeah, the concept is there. Yeah. Bad debt provision of amounts to 1,30,000 and relates to 2 debtors. So you already made a provision of 1,30,000. So in accounts, you already made provision. And how do you show this provision for doubtful debts, or provision for bad debts has a credit balance? You don't show provision for doubtful debts on the liability side of balance sheet. Rather, you'll reduce it. Since this provision for doubtful debts is related to debtors, you'll directly reduce it from debtors itself. So in accounts, no sir, 6,26,000, how have you got? Actually, debtor value was not 6,26,000. It was 626 plus 130. So debtor ka value was 7,56,000. Okay, from 756, you have reduced the provision for doubtful debts or provision for bad debts of 130, and then you have got 6,26,000. Hence, the current carrying amount of the debtor is 6,26,000. Okay, that's one. All right, but now they will sell as per Income Tax Act. You can't do this deduction and all. They will start telling drama. So let's go over the drama. There are 2 debtors. This 130 relates to 2 debtors. They told. Debtor ka name is A and B. Debtor A value is 80,000. You have sold goods worth 80,000 to A. Receivable originated in 20X to X3. Hang on. So currently we are in 31st March 20X5. Okay, that means we are talking about X4, X5. This is our current year. You sold this goods to this particular debtor in X2, X3. That means 2 years before. X2, X3 is 1 year, X3, X4 and X4, X5. So 2 years before only you have sold the goods. And 100% provision is done in accounts. Okay. So in accounts, you already made 80,000 entire provision you have made. And respect to debtor B, 50,000 is the sale amount. That came in X3, X4. Last year only we made the sale. And again in accounts, 100% provision is made. So 80 plus 50,000 if you add, you're going to get 1,30,000. In accounts, we made 100% provision. Let's see in tax what they say. Tax laws allows deduction of 20% provision only for debtors overdue more than 1 year. If the debtor outstanding, if it is overdue for more than 1 year, tax laws permits provision only to the extent of 20%, it seems. Great. And another, look at the word, another means extra. So if it is overdue for more than 1 year, you'll be able to get deduction at the rate of 20%. And another 30% for debtors overdue for more than 2 years. So if a debtor is outstanding for more than 2 years, then how much totally you will get? 20% of this. If it is overdue for more than 1 year, 20%. Then additionally, it's not add on, it's not comma, okay? It's another. Another means extra 30% you will also get provided debtors is outstanding for more than 2 years. So if debtor is outstanding for more than 2 years, you will get 50% deduction, or 50% you will be able to claim as deduction as per tax laws of that particular country. Now, why is this relevant? Debtor A is outstanding for more than 2 years. That means as per tax laws on this particular debtor A, you will be able to claim provision for doubtful debts, or you will be able to get the deduction to the extent of 50%. So what is the debtor A amount? 80,000. On 80,000, you'll be able to get deduction of 50%. So that means as per tax laws, 40,000 provision you can get as a deduction. However, for debtor B, is it outstanding for more than 2 years? No, it can be sold only in the last year. No, that means this is outstanding for only less than 1 year. Okay, I mean, yeah, more than 1 year, but not definitely more than 2 years. So if it is outstanding for more than 1 year, that means on this debtor B, you'll be able to claim the deduction only to the extent of 20%. On this 50,000, you'll get only claim 20%. That will be 10,000. So that means as per tax laws, total provision you can claim is only 50,000 rupees. That is one. Total provision you can claim as deduction as per tax laws is 50,000 rupees. That's one. Now we have to get they asked tax base and DTA DTL. So carrying amount we already know. Carrying amount of this debtor is 6,26,000. That's given. Now tax base. Tax base, what do you do? What is the original value of debtors? I just now told here. Original amount of the debtor was 626 plus 130, which is 7,56,000. Yes. So these two we need to add, because whatever provision you made as per accounts, you add back, because we have to consider provision as per tax record now. 6,26,000 is a debtor amount as per balance sheet. 1,30,000 provision is already deducted as per accounts. This is so add back. What is the provision allowed as per tax laws? 50,000. So deduct 50,000. That will give you your tax base. Okay. So this is an asset. Carrying amount is 626. Tax base is 706. So carrying amount is lesser than tax base. For asset, if carrying amount is greater than tax base, taxable timing difference, you have to create deferred tax liability. Here carrying amount is lesser than tax base. So ulta. So you will get what's it? Deductible timing difference. DTD you will get. The difference amount is 80,000. On this DTD, you multiply tax rate. What is the tax rate? Same, 32%. So 80,000 ka 32% if you do, you will get 25,600. So on this, you'll have to calculate. So they asked the tax base, which is 7,06,000. Then they asked what you will create. You will create deferred tax asset of 25,600. Just 1 second. So which option has 25? This option C, 25,600. This is with respect to your debtors. Next is with respect to inventory. Let's see what they're saying about inventory. Inventory ka carrying amount we already know, 3,04,000. Great, it's already written over here. Then Lal Limited, the company, accounts for inventory obsolescence provision. So they're making some provision for obsolete inventory, non-moving in stock maybe. The new provision created in 20X4X5 is 10,800. We don't want new provision at all. We are creating DTA DTL based on the asset liability approach. We want the total provision, because total provision, whatever is the provision for obsolete stock you have created, the total provision amount, no, we will not show it on the liability side. Since it is related to inventory, we'll reduce it from inventory. Current year you would have made whatever provision, that is irrelevant for us. What is the total provision? Total provision is 18,000. That much you already deducted from accounts. Okay. This provision is not tax deductible as it is a general. So in tax me, you don't get this deduction. Okay. So that means what? As per accounts, this 18,000 provision is already deducted. After deducting, carrying amount is 304. But in tax, can you deduct it? No, you don't get deductions for it. That means you can't, it's already deducted. So how do you get the tax base? You cannot deduct it as per tax law. So hence we need to add back. So add back 18,000. 304 plus 18,000 provision, whatever you have deducted in accounts, add back. So you'll get the tax base to be 322. This is one answer. So again, this is an asset. This is an inventory. Yes, carrying amount is lesser than, carrying amount here is again lesser than tax base. So you will get deductible timing difference of 18,000. On this, you need to create again DTA of 5760. I think they asked tax base and DTA. So check 3,22,000 is a tax base, and on this, you need to create deferred tax asset of 5760. That's the answer. Okay, straightforward question. Done. Next question is with respect to Ind AS 115 revenue recognition. This question, this case study is based on sale with the right to return wala concept. You know, we have done 2-3 questions with sales with the right to return. Sale with right to return means what? First, you will sell the goods and give an option to the customer that if customer does not like the product, he may return this product. Okay, like normally that's what you see it on your Amazon, Flipkart and all that. No, that we call it as sale with the right to return. And we have already studied this provision. What does Ind AS 115 says? What Ind AS 115 says is whenever you have done a sale with the right to return, whenever you have sold with sale with the right to return, wala sale you have done, first you have to estimate what is the quantity sold. Oh, you don't have to estimate, it will be given to you in the question. What is the total quantity of the goods sold? Find out that. And first find out how much quantity you are expecting to get returned. The company has to estimate, because they would have done this arrangement since many years. No, so they have to track their historical performance and estimate how much goods may be returned. So on that goods which are expected to be returned, you cannot recognize right now. You cannot recognize the revenue right now. Only on those quantities on which company feels it will not be returned, only on that they can recognize the revenue. That's all is this question all about. Okay, on the total quantity, if you have sold 1,000 quantities of goods, On entire 1,000, you cannot recognize revenue immediately. Okay. So first you have to find out how much of goods will be returned. Let's say you are expecting about 50 quantity of the goods to be returned. In 1,000, if you are expecting 50 goods to be returned, that means on 50 goods which are expected to be returned, you cannot recognize revenue. What remains? 950. On 950, you are not expecting the goods to be returned. No. So on this 950 only, you can recognize the revenue. That's what they say. This is one. Okay. But this 50 goods is with the customer. No. That means, now see, sir, if a customer returns the product, means what? If customer returns the product, means we have an obligation. Usually in these sort of arrangement, money will be collected. Money will be collected. So that means if customer returns the product, means whatever money we have received on this 50 product, we have to refund him the money. That means we have to create something called refund liability in this particular case. Because if customer returns, we have an obligation to pay his money back on this 50 goods. Yes. So we have to create refund liability. But not only an obligation, we also have a right. What right is that? We will give the money to the customer, but at the same time, we will collect this goods back. That means we have a right to receive some asset. So you'll also create some right to receive asset account. You have to create right to receive asset account. Okay. This right to refund liability, you will create to the extent of selling price. Because if customer has paid the selling price, we have to return him the selling price. But this right to return the asset will be accounted only to the extent of cost price, because this is your inventory. Yes. So this becomes your inventory, you have to value it at cost. That's all is the whole concept of sale with the right to return, which we have discussed. Same thing is applied as a case study over here. We have done 2-3 questions we have done in regular class. I explained the same thing in marathon also, but just quickly giving a recap just to benefit the this particular case. Okay, I just give you the gist. So they have sold goods, sir. They're manufacturing things. All right. 1 minute. The contract is entered for the sale of each product. Consideration is received on the event of delivery of the goods. Okay. Cost of this goods is 400. Selling price is 450. They are selling each unit. Cost price is 400. Selling price is 450. So they have given the right to customer to return. So that means this is a sale made on a right to return basis. Okay, great. So within 30 days, if customer wants, he can return it seems. Okay, fine. The company has sold totally 10,000 molds, some product. That's what they're selling. 10,000 units of product they have sold. So entire 10,000 can we recognize revenue? No. Only on those products which are expected not to get returned. Only on that we can recognize revenue. So from the past experience, company feels that 3% of the molds will be returned. So in this 10,000, they feel 3% will be returned, or is expected to be returned. So 10,000 ka 3% is how much? 300. So on this 300, you cannot recognize the revenue immediately. That means you can recognize revenue only on 9,700. So I'll give you the journal entry for this. I've given. I think we can read this and accordingly answer all the case studies. So what is the journal entry? Normally, if you would have received the money from the customer, if you have received the money, the journal entry you'll write is bank account debit. How many goods? 10,000 units. What is the selling price? Each unit ka selling price is 450. So bank account debit 45 lakh. If you have not yet received the money, means write debtors account debit or financial asset debtors account debit. To what? Can you recognize revenue? No, you can't recognize revenue on entire 10,000 units. You can recognize revenue only on 9,700 units, which are expected not to get returned. So 9,500 into 450, if you do, you'll recognize revenue only to the extent of 43 lakh 65,000. On 3%, the company feels it will be returned. No. So if customers returns that 3% product, then we have to pay the money back to the customer. That means we have an obligation. So we have to create an obligation. The name of that obligation they're calling here as refund liability. Refund liability on how many units? 3% units. So 10,000 ka 3% is 300. So 300 into 450, which is 1,35,000. This is one. Okay, only this up. No, we have a right to receive asset also, right? We'll record this. So entry, if you wanted, one more entry will pass is right to receive asset account debit, but this will be recorded at the cost price. How many units? We have a right to collect back 300 units from the customer, and the cost of each product is 400. That means you will create or record this asset to the extent of 1,20,000. So the journal entry will pass is right to receive asset account debit to cost of goods sold, because your inventory, inventory and all gets reflected in COGS. So this is the 2 entry. Based on this, they've asked some MCQ question. Okay. Here they're asking the consideration received from the customer is fixed or variable. So normally, sir, here see whether he's going to refund this amount or not, we are not very sure. That means how much consideration finally we'll receive. No, it's not fixed. It is variable. Then since the customer can return some product, so how much consideration we'll ultimately receive, you cannot say with certainty. Hence, on that ground, we say here the consideration is variable. That's one. Okay, second one is upon transfer of control of 1,000 units, we will recognize revenue of what? Entire 10,000 units may recognize revenue? No, you will recognize revenue only on the goods not expected to be get returned, which is 9,700. Okay, the company will recognize how much revenue totally. We gave you the journal entry already. How much revenue totally you will recognize? You recognize revenue to the extent of 43,65,000. Select that option, which is B for Bengaluru. The entity recognizes refund liability. How much? We already got that. Refund liability to the extent of 1,35,000. Which option is 135? See if Chennai has that. Select it. The entity recognizes return asset to what extent? 300 ka cost price. 300 into 40, which is 1,20,000. That much you'll recognize. Journal entry they are asking, sir. What is the journal entry? First journal entry. They've assumed that money is not received. So instead of bank, they've written debtors account debit to revenue account to refund liability account. That's the entry, same thing we pass. So select that option. That's all. For your standard, hardly anything. Correct now. Yeah. Okay, next case study. All Limited holds 35% total equity shares in M Limited. So with 35%, we get significant influence. So M Limited is our associate. Yeah, given also. The value of investment is 3 crore rupees. Okay, in consolidated financial statement. All Limited, that is the parent, sold goods worth 3,50,000 to associate company. So sale has been made. There's an unrealized profit or adjustment the moment you get to know. Because all the sale would have not happened at cost price. They would have done it at selling price. So check that. The cost of the goods is 3 lakh, but we sold it for 3,50,000. Unrealized profit means total profit you'll eliminate. No, unrealized profit means profit element included in closing stock. We might have sold 3,50,000 worth of goods. Entire 3,50,000 might not be there as inventory with associate company. You have to eliminate unrealized profit only to the extent of the inventory lying or goods lying still with the associate company. Check here. Out of these goods costing 1 lakh to M Limited. Keep that in mind. This is the cost of 1 lakh to M Limited. All Limited, we have already sold. So for All Limited, this is a selling price. Correct? But see, if a selling price for the seller becomes purchase price for the purchaser. So they're talking from M Limited perspective. From M Limited perspective, this is the cost. Who sold it but? All Limited. That means this 1 lakh is not the cost price. It is actually selling price because All Limited has already sold it. Who made the profit? All Limited. From the seller perspective, you need to figure out whether this particular 1 lakh, the goods remaining, it represents cost price or selling price. So seller has already sold. For M Limited, it is a cost means M Limited is a purchaser. For purchaser, 1 lakh is a cost means for seller, 1 lakh will be the selling price. Since seller made the profit, from seller perspective, you have to find out whether it is a cost price or selling price. So this is from seller perspective, 1 lakh is the selling price. So what is this 1 lakh? Out of these goods costing 1 lakh to M Limited, where in closing stock of M. So associate is not holding. We sold totally 3,50,000. Entire 350 is being held as inventory? No. Only 1 lakh is being held. So unrealized profit for calculation. So let's calculate that off. What is the profit? Like this proration. If the selling price is 3,50,000 means profit will be 50,000. Same, no. Cost of the goods was 3 lakh. We sold it for 3,50,000. So how much profit? 50,000. So if the sale value is 3,50,000 means profit is 50,000. Profit made by the seller is 50,000. Entire 350 is lying as inventory? No. Only 1 lakh worth of goods is lying in the inventory. And from seller perspective, that 1 lakh is a selling price. So if 1 lakh is a selling price means how much is the profit? How much is the profit? Prorated. You will get 14,285. This is the unrealized profit. If you're doing subsidiary consolidation, entire 14,285 you will eliminate because we show what, sir? When you're doing subsidiary consolidation, subsidiary ka entire assets and liability we show. But this is not subsidiary consolidation. This is equity method ka associate consolidation. In associate, we are not bothered about total unrealized profit. We are only concerned with parent's share or investor share of unrealized profit. How much does investor own? 35%. So 14,285 ka 35% you calculate, that comes to 5,000. Only 5,000 is unrealized profit which you need to reduce. So from where you will reduce? We'll reduce it from the investment. That's all it is. Okay. I told you the logic of this also. Because if you have sold it at profit, if investor has sold this goods at a profit means subsidiary will show this. I mean, so now who has that closing stock? Associate company. So associate company ka closing stock will be unnecessarily inflated. Because since parent company or investor company sold goods at profit, right? So the profit element is included in associate ka closing stock. So associate ka closing stock will be increased. If associate ka closing stock increases means the net assets of associate company will increase. And we as an investor, we have a share in net assets only. So if net asset increases means unnecessarily our investment balance also will increase, which we need to eliminate when we prepare CFS as per equity method, which I had told you. Yes. So this unrealized profit of 5,000 you need to reduce from the value of investment. That is one. Okay. All right. Next, what they're asking. What did they say? The associate company, they also declared a dividend of 75 lakh. So whenever they declare the dividend, their net assets will fall. So our investment value also will fall to entire extent, no, only to our share of dividend. 75 lakh, our share 35%. Okay. During the current year, SPL of associate company showed a profit of 1.5 crore. So associate company made some profit. If associate company makes profit, their net assets will increase. So accordingly, our investment balance also should increase. To total extent, no, only our share of associate profit. So what are they asking? what is share of A Limited, the investor, for post-acquisition profit of M Limited. So our share of profit they're asking. What is the profit? Total profit is 1.5 crore and we own 35%. So 1.5 crore ka 35% you're going to get 52.5 lakh. That is the parent share of associate profit. What is unrealized gain? We already found out that. Unrealized gain is 5,000. So select A for 5,000 as the right option. Next, what is A share of dividend declaration? Our share of dividend. Total dividend declared is 75 lakh. Our share is 35%. That will be 26 lakh 25,000. At the end, they're asking value. What is the value of the investment as per equity method? So simple funda. So how much did we buy the investment for? 3 crore rupees. So add that. So what is our share of associate profit? If associate makes profit, investment balance will increase. So increase it by 52.5 lakh rupees. However, if there is any unrealized gain on inventory, we need to reduce how much? We already got that unrealized gain of 5,000. So due to this, investment balance will reduce by 5,000. Then associate company declared dividend. What is our share of dividend? 26 lakh 25,000. So that we need to reduce because due to dividend declaration, net assets will reduce. All this we have solved in our regular class, many questions. Quickly tell you. Yes. So the final value will be 3 crore 26 lakh 20,000. That's the value of investment. Okay. Then they're asking you what is appropriate gross margin on sale. When they say margin, margin is always expressed on sales. When they say markup, the term markup means profit element on cost. When they use the word margin, margin is a profit percentage expressed on sales. So they're asking you what is a profit margin on sale on the goods sold by all limited to M limited. How much did parent sell any goods to associate company? Yeah. 3 lakh is the cost of the goods, but we sold it for 3 lakh 50,000. So how much profit we made? We made a profit of 50,000. That's the profit. So how do you get margin? They're asking profit margin. That is nothing but profit upon sales into 100. Sale value is 3 lakh 50,000. Profit is 50,000. So that means the margin will be 14 into 100. If you do, you're going to get 14.29% is what my calculator showed. That's what I've written over here. That's all. Okay. Yes. Next question. On 1st April 20x1, A Limited acquired 80% share capital of S Limited. So with 80%, we obviously get the control. On acquisition, on the acquisition date, the share capital and reserves in surplus stood at 5 lakh and 125 respectively. So they have given your, equity and other equity portion. We're using this only, we're going to get net assets. Yes. One way to get net asset is asset minus liability approach. Another one is simply take equity and add other equity. You will get the net assets. So here I think they've given these two data for net assets calculation on the date of control. A Limited paid initial cash consideration of 10 lakh rupees. PC given in the form of cash. Additionally, A Limited issued 2 lakh equity shares with a nominal value of 1 but at a market value of 1.8. So PC is also given in the form of equity shares. And what is the market value of each equity shares? 1.8. And how many shares we gave? 2 lakh. It was also agreed that the A Limited parent would pay a further sum of rupees 5 lakh after 3 years. This only we call it as deferred consideration. Is deferred consideration part of PC? Yes. But present value of deferred consideration should be considered because this 5 lakh you're not paying now, you're paying after 3 years. So cost of capital is 10%. They've only given third year ka discount factor is 0.75. So 5 lakh into 0.75 you do. Okay. The shares and deferred consideration is not yet accounted, it seems. Okay. They've given balance sheet. That's fine. Now they're giving requirement. Actually, this is a ditto question, sir. This is a full-fledged consolidation question. Instead of asking us it as a consolidation, prepare consolidated financial statement, instead of asking us to prepare that, they have given various MCQ questions. So 10 or 12 MCQ questions they have found and we need to do it. But it is as good as preparing consolidated financial statements only. Okay, same it is. On the date of acquisition, fair value of subsidiary ka plant exceeded book value by 2 lakh rupees. Fair value adjustment. Yeah, should we consider? Yes, absolutely yes. Where? For net assets on the date of control wala calculation. Remaining useful life is 5 years. So due to this fair value adjustment or fair value increase, you will get some extra depreciation, which you have to consider. Under where? The analysis of profits. Post-acquisition profits we need to reduce this. All this we have done. Consolidated goodwill is impaired by 2,58,000. So impairment loss. Who will bear it, sir? It depends. If NCA is valued under PSNA, proportionate share of net asset basis, then this 258 will only be, impairment loss of 258 will only be taken up by the parent. However, if NCA is valued under fair value method, then the goodwill that you get will be full goodwill and impairment loss on goodwill will be taken up both by parent and NCA. So group is valuing NCA under fair value method. Awesome. So the fair value of NCA 20% is given to be on the date of control. They're saying fair value of NCA is 3,80,000. Awesome. So what do they want? First, they are asking you PC. What and all you gave as PC? 10 lakh you gave as PC. Then you gave 2 lakh equity shares. Each market value is 1.8. So the market value of equity shares given is 3,60,000. Then you want to give 5 lakh rupees. You will not give it now. You will give it after 3 years. Hence, we have to find out present value. 5 lakh into 0.75 is the discount factor we just now saw. Add everything, you're going to get 17,35,000. You have to express all these numbers in thousands. Okay, so 17,35,000. If you want to express in 1,000, it will become 1735. So that is the right option. Okay. Very, very straightforward question. Like this, we have done 3-4 questions in our regular class. Yeah. Ditto question, but instead of preparing it as a full-fledged consolidated balance sheet, they are asking it as a MCQ. That's all. No change. No new concept at all. Calculate net assets they are asking. So how do you calculate net assets? They have given equity and other equity. What is equity ka value? 5 lakh. And retained earnings ka 1,25,000. So these two you add. Plus, is there any fair value adjustment? Yes. Fair value adjustment is there. How much is that? Compared to book value, fair value of the asset has increased by 2 lakh. So that also will be considered. So add all this, you're going to get net assets on the date of control to be 8,25,000. Next, they are asking you goodwill. How do you get goodwill? Take PC. PC is 17,35,000. Add NCI. NCI's value is given to be 3,80,000. And deduct net assets on the date of control, which we just now got it to be 825. And you'll get goodwill on the date of control. Okay, on the date of control. Now they're asking goodwill on the reporting date. So first of all, check the control date over here. Control date is 1st April 20x1. Keep that in mind. But balance sheet is given to be 31st March 20x3. So that means we are not doing consolidated financial statement of the first year. You got control in the last year only. We are on 31st March 20x3. Yes. So 2 years over. We are in the second year now. For the second year, we are preparing consolidated financial statements. And we know that CFS is a recurring activity. Till you have control, you have to go on preparing consolidated financial statement. So second year ended, they're asking you what is the goodwill that you will show in consolidated balance sheet. Yeah. What is the goodwill on the date of control? 1290 expressed in thousands. Was goodwill subject to any impairment? Yeah, there was an impairment. They only gave, how much was that? 2,58,000. So reduce 2,58,000 ka impairment loss. You'll get the goodwill on the date of reporting, which is 1032. That's all. Next, they're asking you what is the net value of PP that you will show. Obviously, in consolidated balance sheet, you will show PP. That they're asking. So what do you do that? Take parent ka PP, add subsidiary ka PP. If there is any fair value adjustment, add it. Due to fair value adjustment, if you are getting any extra depreciation, reduce that. That's all we need to do. So parent ka PP here in the question, if you want, I'll just show you. Parent ka PP is 5,500, subsidiary ka is 1,500, which they've added. Okay. Then there is a fair value adjustment. Just now we saw it to be 200. But due to fair value adjustment, you will get extra depreciation. Okay. Remaining useful life, they only told us how many years? 5 years. So this is 2 lakh. We have to do all calculations in thousands. So 2 lakh, if you have to express in 1,000, it will become 200. So this 200 additional fair value adjustment has to be depreciated over 5 years. But if you do 200 divided by 5, you will get 1 year depreciation. Sir, we are not preparing consolidated financial statement for the first year. We are preparing it for the second year. So that means we have to multiply by 2 years, because 2 years ka depreciation you have to consider, because that's where we are in. So multiply by 2 over here. Normally we used to consider 1. Same question we have done. Similar one is there in our book also, where we have done second or third year. I think it was, I forgot that name, Blue Haven Limited or something was there in our question. One case study we had that given, one case study that given 4 or 5 questions. All that we have done here like this. Same adjustments are there in that regular class also. Similar, but just they've changed the name and value and bring it made up a question. So do not forget to consider 2 years ka depre here. So if you do that, you're going to get PPE value to be 7120. Compute the value of NCI they are asking, but not on the date of control, but on the date of reporting. We already know the value of NCI 2 years before. On the date of control, NCI ka value is 380. Now they're asking after 2 years, when you prepare consolidated balance sheet, what is the value of NCI you will show in that consolidated balance sheet. And that what do you do? If there is any post-acquisition profit of subsidiary, add back. Now check what is the check how do you get that? Sir, on the date of control, retain reserves and surplus of subsidiary company or other equity of subsidiary company was 125. I'm telling in thousands, 1,25,000. But after 2 years, if you just check, their retained earnings has become 300. On the date of control, it was 125. Now it has become 300 means what? So 300 minus 125 is nothing but what, sir? 175. That is your post-acquisition profit. Yes. That will be distributed straight away. No, hang on. There is some consolidation adjustment also. Was there any fair value adjustment? Yes. Due to fair value, you will get some extra depreciation. You already computed that. How much is extra depreciation? 80. Reduce that first. Okay. Fine. And then, was there any impairment loss on goodwill? Yeah. There was an impairment loss of 258. Reduce that. Then you will get what, sir? You're not getting profit. You're getting a negative number, meaning it's a post-acquisition loss. Doesn't matter whether it is post-acquisition profit or loss, it will get distributed both to parent and NCA. Parent 80%, NCA to the extent of 20%. We want only NCA ka calculation here, so calculate 20%. NCA share at 20%. 163 ka 20% if you do, you're going to get 32.6. So on the date of control, NCI balance was 380. Now, if it was post-acquisition profit, see when you make profits, net asset will increase. So NCI balance also will increase. This is a post-acquisition loss. So when subsidiary company reports post-acquisition loss, their net assets will reduce. So NCI balance also will reduce. So these two you sum it up. 380 minus 32.6 if you do, you're going to get NCI on the date of reporting. That is 347.40. All right. Okay. Next is what is post-acquisition gain or loss of parent? Parent ka share of gain or loss they're asking. What is post-acquisition profit or loss? Post-acquisition loss is 163. In that parent ka share is 80%. So take 163 multiply by 80%. This is loss share. So loss of 130.4. Okay. Now they're asking finance cost. So what is this finance cost? Sir, was there any deferred consideration? Yeah, 5 lakh, there was a deferred consideration. We did not record that deferred consideration at fair value. We recorded that at present value, right? Because you're settling that after 3 years. And they told the question that all that was not recorded. That means now we have to record that. So since it was recorded at the present value, and the present value was how much we got there? Present value here was, one second, loading, 3,75,000. You will pay 5 lakh after 3 years. The present value of that is 3,75,000. So the difference between this present value and future value is nothing but your time value of money ka interest charges or finance charges. That is what they're asking. That means we need to prepare that ACM table, sir. Yeah, you need to prepare that ACM table. For 3 years, that's what I've done over here. Quickly. Yes. So opening balance is 375. Calculate finance charges at discount rate given in the question to be 10%. Payment will be nothing because payment will be made only at the end of 5th year or 3rd year rather. So you'll get the closing balance. So each year ka closing balance I've got it. Why? Because they asked you finance charges for year 1 and year 2. Both put together. That's the reason I've prepared for all the 3 years ka ACM table over here. So first year ka finance charges is 37.5. Second is 41.25. So select that option. Okay, that's one. Next, they are also asking you what is the value of deferred consideration as on 31st March 20x3. Okay, and what is this value of this particular deferred consideration? Because you make provision for this, no? When you pass consolidation entry, you have to show provision for DSR in your consolidated balance sheet. So on 31st March 20x3, they're asking you what is the balance that our ACM table will give. On 31st March 20x3, the provision for deferred consideration balance is 453.75. That's what you need to select here. Okay. All right. This question they're asking what is the consolidated retained earnings you will show in your balance sheet. Retained earnings. In retained earnings, what do you do? Take parent ka retained earnings, which is 1,400 given in the balance sheet. To that you add what? Subsidiary ka post acquisition profit. But here it is not post acquisition profit, rather it is post acquisition loss. What is the parent share of post acquisition loss? 130.4. Deduct that. Then, sir, this finance charges and all, they told it is not accounted. So we have to account it now. So how many years ka? We are doing consolidation for the second year. So both the year ka finance charges we need to reduce because this is not P&L we're preparing. We are preparing retained earnings. So retained earnings from the beginning till date, whatever adjustment is there, everything has to be considered. So 2 years ka finance charges, if you reduce it, you will get 1190.85. That's the value of retained earnings you will show in your consolidated balance sheet. Now this is already over. Next, they're asking you compute the value of current liability. What will you show as current liability? Take parent ka. What is parent ka current liability? 1250. Subsidiary ka 650. Okay, normally you do this if there is any intercompany transactions like creditors, bills payable that you need to eliminate. Here we read the question, we didn't get that. But hang on, this provision for DSR. Why did they specifically ask this question? Is this not DSR rather this provision for deferred consideration. We are preparing consolidated balance sheet on 31st March 20x3. So this provision for DSR, where will you show? Will you show it as a current liability or as a non-current liability is a question. This has to be showed as a current liability. Why? Sir, we know this. Anything expected to be settled within 12 months from the balance sheet date. From the current balance sheet date, count 12 months. From 31st March 20x3, count 12 months means you will get 31st March 20x4. If any liability, if it is expected to be settled within 12 months from the balance sheet date, such a liability, we call it as current liability. This 453.75 will be paid within the 12 months from the balance sheet. Hence, in the current year balance sheet, you have to show this 453 as a current liability. So that also needs to be added up. So if you add it, then you will get the the total current liability to be shown in the balance sheet. And then they're asking you the total consolidated balance sheet ka total they're asking. Either do it from the liability side or asset side. So I have put it from the asset side. Do not forget to put up the goodwill. So normal problems, no sir, if they ask you, these are very, very straightforward question. Aram say you'll do it. But now they've asked the whole consolidated balance sheet only they've asked. But as a small MCQ question like this here, check, they're asking the total. So you'll have to visualize and be careful. So some small errors can happen over here. So be careful. Like goodwill not being considered like that and all. Or when you are doing total, you may consider investment in subsidiary. Because in this balance sheet, no, you have investment in subsidiary company. All this should not come. Instead of this, only goodwill will come. So all that arithmetical mistakes can happen in these sort of, when you are preparing the same question as a MCQ. Because our mind is used to preparing that consolidated balance sheet in a certain format. So as long as they ask in that format, aram se we'll do. But the moment here, no, we have to let go of all that format because we will not have time to do everything, right? Because if you solve it in that proper format, which we used to do in our class, at least 30 minutes it will take. If this question comes for only like 10 marks or 12 marks, spending 35 to 40 minutes on that question is not worth the time, right? So you need to be a little careful and a little more smarter when it comes to all that. Yeah. All right. So that is with respect to this question. Then what's sir? Let's take up this question now. I think this was there in your MTPs. I think this one. Okay. A Limited, they're saying is a diversified business group, so they are into many businesses. Fine. So they have many subsidiary also. Full goalie they're giving. So let's go into that. B Limited, the main company parent is A Limited. They have one subsidiary B Limited. Reported a net income of 25 lakh. Okay, subsidiary ka profit is 25 lakh. Great. Which is equal to company's comprehensive income. Great. The company has no outstanding debt. Following is the information from comprehensive balance sheet. Okay. Now they have given. Equity share capital as on 31st March 20x2 is 100, as on 31st March 20x3, which is 100 again they've told. Further issue of equity shares, 100 and 140. Indirectly they're telling you what's a extra 40 lakh equity shares. I think all these numbers are in lakhs, no? Yeah. Extra 40 lakh equity shares have been issued in the current year. So better approach here is, again, as I told, some question, no? When you read the question, you'll not get to know what are they trying to ask. So if you read the requirement, you'll get a better idea. So here they're asking check. Under financing activity, what will you show? This is a cash flow statement wala question. Under financing activity, what you will show? Simple. You've issued equity shares. From 100, it became 140. No? So we issued equity shares worth 40 lakh. That is one. All right. Next one, check. 100 is a retained earnings for opening balance. Closing balance is 115. But hang on. The subsidiary company made a profit of 25 lakh. No? So that means the retained earnings ka balance should have been 125. Because opening balance was 100. Current year, they reported a profit of 25. So it should have been 125. But its balance is only 115. So it is not 125, it is only 115. That means what? 15 lakh rupees, there is a difference. What is that difference? So that they are asking about dividend paid. Because how can you say it is dividend, sir? Check the adjustment. In the adjustment, they are only talking about equity shares and dividend. So that means you need to conclude that 10 lakh rupees. Retained earnings is obviously reducing due to 10 lakh rupees dividend paid. So if you have issued equity shares worth 40, you have paid dividend worth 10. So option number D is the one that has a particular numbers, so you'll select that particular question. Okay, simple one, but when you read the question, it looks like a little different. So look at the options first. That will guide you better. Okay, next option also maybe we'll read off. With respect to point number T, what cost should be included in entity's financial report for the quarter? Okay, this is they're talking about India's 34 interim financial reporting. They're asking. So now we'll come back to the data again. A Limited also operates in travel industry and incurs the cost unevenly. Advertising cost of 40 lakh was incurred on 1st July. We know the funda. What is that funda? Sir, simple funda. How do you prepare interim financial reporting is like this. If think that you're preparing annual financial statement. In annual financial statement, if you can defer the expense, then in interim financial statement, you can also defer that expense. If you're preparing annual financial statements and if you cannot defer that expenditure, then in interim financial statement also you cannot defer it. Like here, advertisement expenditure is incurred. If you're preparing annual financial statement, and if you have incurred 40 lakh advertisement in the current year, will you account it in the next year or current year itself? Current year itself. So that means this 40 lakh of advertisement expenditure incurred in this quarter has to be booked in this quarter only. Okay, that's one. Next, staff bonus are paid at year end based on sales. Okay, staff bonus are expected to be around 400 lakh. This is expectation based accounting. Yes. So and sum of 60 lakh rupees would be relating to the period ending 30th September 20x2. So our quarter, no sir, is we are talking about second quarter, 1st July to 30th September. For this quarter, we are talking about it. Yeah. For this quarter, what is the related staff expenditure they're saying? You need to make a provision to the extent of 60 lakh. So basically 40 lakh and 60 lakh, we need to account it for the second year. So look at that option. Advertisement expenditure of 40 lakh and staff bonus of 60 lakh is what we need to account it in this particular quarter. That's what they asked. What will be transferred to P&L account? What cost should be incurred? 40 and 60 is a cost to be incurred for the second quarter. All right. Now the third one is with respect to annual depreciation charge. Some depreciation relating to equipment they're asking. Okay, let's look at this. An item of equipment was acquired by A on 1st April 20x1. Okay, for 1 lakh, having an estimated useful life of 10 years. Residual value is 0. So 1 lakh is the original cost. Residual value is 0. You have to depreciate over 10 years that means the depreciation every year is how much, sir? Depreciation every year is 10,000 rupees. Correct? No? All right. Okay. Now, when did you buy the asset? Keep that in mind. 1st April 20x1. We are not talking about 20x1. We are talking about 31st March 20x3. So current year is what? Current year is 1st April 20x2 to 31st March 20x3. Okay. All right. So one second, you purchased the asset on 1st April 20x1. So first year, second year, 2 years is already over. Okay. So 2 years, the depreciation will be 10,000 respectively for each year. So total depreciation for 2 years is 20,000. Okay. The asset was depreciated on a straight line basis. Asset was revalued on 1,04,000 on 31st March 2000x3. Or you have done some revaluation. So if you do revaluation, will the depreciation be changed? Will it be same? No. Due to revaluation, your carrying amount will change. So your depreciation also will change. I think I worked out this. Once again, I'll show you. So carrying amount will be 1,04,000 right now. Okay. That means from year 3 onwards, what will be the depreciation? revised carrying amount is 1,04,000. Salvage value there is no change, 0 only, divided by remaining useful life. When you bought the asset, total life was 10 years. 2 years is already over. So remaining life is 8 years. That means now the depreciation will be how much? 13,000 rupees. Okay. For the first 2 years, how much was depreciation? 10,000 every year. Now after revaluation, it has become 13. So we know this concept already. What is that? What India 16 says is due to revaluation, if you are getting any excess depreciation or if you're getting any extra depreciation, then that extra depreciation you can transfer from revaluation surplus, you can release it back into retained earnings. This is not a compulsion, this is optional. If company wants, they can utilize it and not do it. Okay. Check what before revaluation, how much was depre? 10. After revaluation, it has become 13. So how much excess depreciation you are getting only due to revaluation? Only due to revaluation, you are getting 3,000 depreciation extra. That company has a choice to transfer from revaluation reserve to revaluation surplus or revaluation reserve to retained earnings. So you need to select that option. Okay. So annual depreciation is 13,000 and annual transfer of 3,000 may be made, not compulsorily made. It may be made because it's an optional. May be made from revaluation surplus to retained earnings. So hence C for Chennai is the right option. Yeah. All right. Fourth option is they're talking about tax base of intangible assets. So only tax base. So come back. Where is that? Company has spent 15 lakh in developing a new product. So internally generated intangible asset. Okay. All right. The development costs were recognized as intangible asset as per India's 38. The TIFRC condition is getting satisfied. So you have capitalized the development phase expenditure. Okay. For the purpose of computing taxable income, these expenditure are allowed in full in the year of expenditure. In as per tax laws, no. In whichever year you will incur the expenditure, that day only fully you will take it as deduction. I mean, what is the tax base? Same thing we saw in the previous case study also. Carrying amount may be 15 lakh, okay, or whatever it is, after amortization, whatever. But they asked only tax base. Tax base is what? 0. That's all you need to select. So tax base for this option is what, sir? Nil. That's all. I don't have to even read further because no, they did not ask DTA, DTL and all. Only tax base. Next, they are asking about classification, appropriate classification of annual payment of 12,000 to preference shareholders. So you're paying something to preference shareholders. They're asking its classification. What is this, sir? Sir, whenever you have company as preference shares are either classified as equity or financial liability. If you're classifying preference shares as equity, then whatever dividend you pay, okay, it will not be shown in P&L. It will be directly accounted in your other equity. It will be deducted from retained earnings. Yes. However, if you are classifying preference shares as a financial liability, then you may call it as I have paid dividend, but the dividend will be accounted as a finance charges in P&L account. Probably that they're asking. Okay. So we need to check whether what is the classification of this preference shares. The company has issued preference shares that are redeemable at the option of holder. Okay. I can stop there. If holder has the option means obviously it is what, sir? It's a financial liability. Yes. Because whatever holder chooses, the company cannot escape from it. So since the company doesn't have choice, okay, because if the holder chooses cash option, we have to compulsorily go for cash option. So if holder has an option means such preference shares will be classified as financial liability. So anything, whatever you pay will be showed as an interest charges or finance charges. So how much payment you made? 12,000. That will be booked not as a dividend. You will not reduce it from other equity, but you will book it as interest expense and account it in P&L account. Okay, that is one adjustment. Okay, next case study. This is also I think MTP 24 case study only. One company they have given, they are saying it also is preparing blah 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 blah. Okay, they are in mining industry. It seems they are preparing full story they are giving. Directly we'll come to the adjustment part. Okay, so first maybe we'll read the requirement once. With respect to joint operation, what you need to do? Some liability they are asking with respect to joint operation. Okay, this is a typo. It should not have been current liability. In my opinion, it should be current asset. Okay, all right. I'll just tell you. I think this is a small mistake in this question, in my opinion. Then they're talking about preference dividend from basic EPS perspective. Okay, we'll see what that is. We'll just get an idea. So we don't have to read this adjustment in detail. Just have a quick idea so that in what context we have to read that case study, you will get an idea. Because sir, information like earlier, no sir, what happens earlier, the way it used to be is each standard were different. Accounting standards, sir, they're not much interconnected. But when it comes to India, there is a lot of interconnection. One paragraph when you read, you can interpret from various angles, right? Like provision for DSR, right? Provision for DSR will be added to the cost of PP also at present value. At the same time, there is unwinding of interest or there is some interest charges on provision for DSR also. That has to be booked to SPL. So that means a particular scenario can be interpreted in multiple ways and multiple standards gets triggered. So when you just have a quick overview of the requirements, then you will be able, you will read, when you read the case study, you will get to know in what context you need to answer, and that will make you to get the answer faster. All right, this one. And then they're asking some cash flow statement ka inflow. Great. Then they're asking some goodwill or bargain purchase gain on acquisition of S Limited. Okay, great. So now in that context, let's go and read our main case study. Point number 1. U Limited and F Limited are partners in joint operation. They're engaged in the business of mining process. Okay. There was some inspection done by the government authority. Government has done some inspection. They're saying safety measure is not followed and government has put a penalty of 50 crore. Okay. Government wants to put a penalty of 50 crores on you. Now what? So we check with our lawyers. The legal counsel is saying has assessed that assessed the demand and opined that appeal may not be useful and the appeal orders will be unfavorable to the joint arrangement. So they are saying we have to pay penalty. Okay. So they're saying obligation is probable. If obligation is probable, what we have to do? We have to recognize a provision. So which is the company? U Limited. So they have to recognize a provision of 50 crore rupees. Okay. But this is not just U Limited. This is a joint operation. Okay. So see what they are saying. Out of 50 crore paid to be paid by U Limited. So U Limited only has to pay it. Because obviously if it's a joint arrangement means government may not make both the parties payable. Government will say, government is asking U Limited, you pay. And later on you figure it out among yourself who has to share how much and you do your cash flow arrangement. I will not interfere. So government is putting the payment responsibility on U Limited. That's what they say. To be paid by U Limited. So if U Limited is paying 50 crore means they have an obligation to pay 50 crore and obligation is probable. So they have to recognize provision to the extent of 50 crore. Okay. And then what they are doing? 30 crores will be reimbursed by F Limited. Okay. You will pay 50 on one hand. On another hand, they will recover 30 crore rupees. We have studied. This is nothing but a what, sir? Ind AS 37, we have studied this as reimbursement. Yes. So what does Ind AS 37 say? Reimbursement should be recorded as a separate asset. It should not be netted off with provision in balance sheet. Reimbursement should be shown as a separate asset provided it is virtually certain. So what this U Limited has to do over here? They have to recognize a provision of 50 crore separately, recognize reimbursement asset of 30 crore separately, provided it is virtually certain, which I don't know whether they've commented or not. Actual reimbursement was not received from F Limited. Actual reimbursement is not received, they're saying. We don't do the accounting on a receipt basis. We want to know whether it is virtually certain. That's all. Okay. So now look at this option. In this context, first one we need to write. With respect to joint operation, how the liability will be disclosed. They're only asking the liability perspective. What U Limited has to do? Provision is a liability, but with uncertain timing and amount. Provision is also a liability, but when it will come, to what extent it will come, we can't say with certainty, but we can only estimate. So they're only asking from the liability side, we need to make a provision of 50 crore. That's all. Yes, that's the option. That's it. They're not talking about reimbursement asset, so let's cut that off. All right. Second option with respect to lease. U Limited leased a machinery from D Limited. So U is the lessee, D Limited is the lessor. Okay. On a 3-year lease term. The expected future economic life of the asset is 8 years. Okay. Asset life is 8 years, it seems. If machinery breaks down, then under the terms of the lease, the lessor will be required to repair the machine or replace the machine. Okay. D Limited agreed to allow U Limited to use the machinery for first 6 months of lease without the payment of any rental as incentive. So first 6 months is saying you use it, I'll not charge you any lease rental. Okay. That's like an incentive which lessor is giving to the lessee. After this initial period, lease rental will be 2,10,000 payable 6 monthly in arrears. So lease rental you have to pay every 6 months. How much is the lease term? 3 years. In 3 years, you're paying lease rental half yearly basis means totally there has to be 6 payment. But the first 6 months, lessor told you don't have to pay any payment. That means the payment will only be for how many months? 5 payments totally you will make of 2,10,000 each. So that means the total payment will be 10,50,000. Correct? Yes. Totally 6 because 3 years ka lease means half yearly payment if you're doing, you need to make 6 payments. In a year, 2 payments you need to make. For 3 years, there will be 6 payment. But the first payment, lessor is saying you don't have to make. So only 5 payments, that is 10.5 lakh rupees is the value. Okay. All right. First payment falling due on 31st March 2023. I'll tell you what the problem is in this question. So they are asking calculate the current liability of the leased machinery from the D Limited. What is this current liability? And the way they've asked this question also, I'll just quickly show you the solution also. What they are saying is, in accordance with the principle of Ind AS 116, lease of machinery is an operating lease. Sir, you tell me, sir, in Ind AS 116, is there any concept of operating lease, finance lease for lessee? No. As per Ind AS 116, lessee always has to record what? ROU and lease liability. Only lessor has to worry whether it is an operating lease or a finance lease. So I think they wanted to ask the question from lessor perspective, but the question got jumbled up and got asked as a finance lease. Okay, the whole question is a little bit off here, but still, I'll tell you how they got the right answer. Okay, I'll just tell you in journal entry. So I already told you the payment. How much is that? So 2,10,000 is a payment, and you need to make the payment for 5 years. So if it is operating lease, they've given the answer based on operating lease. So if it is operating lease, what should the lessor do? This from lessor perspective. That's how you'll get it. Otherwise, in fact, I can skip this question, but still, I'll tell you how they got that answer. Excuse me. So if it's a operating lease, what does the standard say? Lease rent, you don't have to do ROU, lease liability accounting and all. I mean, lessor has, if it is a finance lease, first of all, lessor has to de-recognize the asset and he has to show receivable. Yes. But however, it's an operating lease means what will the lessor do? He will book lease rental income. Whatever lease rental income he has received, he'll book it as an income and transfer it to P&L. But there is a catch. What is that? The income has to be booked by the lessor on a straight line basis, SLM basis. Every year he has to book the same income. Okay, that is the catch, right? So how much is that, sir? How much is the lease rental? 2,50,000 is the lease rental. How many? 2,50,000 is one payment. How many times the payment will be received? 5 times. So if you multiply, you're going to get 10,50,000. So the total lease rental is 10,50,000. This total lease rental, lessor has to account it over the lease term. What is the lease term here? 3 years. So equally, he has to book this 10,50,000 as income over 3 years. So 10,50,000 divided by 3 years, if you do, every year, lessor has to book an income of 3,50,000. In his P&L, he has to book an income of 3,50,000. So what is the journal entry? In the first year, so lessor has received the money, no? So bank account debit. In the first year, did he receive entire money? No, he received only one payment. For the first 6 months, he did not receive any payment. For the next half year, he received a payment of 2,10,000. So bank account debit 2,10,000. But income you have to recognize to the extent of 350. Income is 350, but received is only 210. That means you will account it as accrued income. So accrued lease rental, you account it as 1,40,000. Okay, next year what it will be? Next year, lessor will receive 2 payments for year 2. 2,10,000 ka 2 payments. So bank account will debit 4,20,000. But lease rental income will every year will be 3,50,000 only. 420 of debited, 350 of credited. So that means what you will do? Last year there was an accrued income, no? That is received over here. So you'll write as to accrued income 70,000 arrived as balancing figure. Okay. Now what do they mean by current assets? Now check, sir. What in the first year in the question they are asked what is the value of current asset? It should not be current liability. It should be current asset. So this accrued lease rental is accrued income is an asset, no? So they are asking you what is this accrued income, a current assets or a non-current asset? So check how much have you accounted? 1,40,000. First of all, what does a current asset mean? Any component which is expected to be realized within 12 months from the balance sheet date is one of the feature of current asset. Yes, you have to receive it within 12 months from the balance sheet date. Check how much did you account it as accrued income or current assets in the year 1? 140. But how much is getting adjusted in year 2? 70. So out of 140, 70 is getting adjusted in next year. By the end of 12 months from the balance sheet date, out of 140, 70 is getting adjusted. So out of 140 in year 1, no, 70,000 you have to show it as current asset and balance 70 you have to show it as non-current asset. So that is the option. That's what they're trying to say over here. Okay, that's how they selected this. Got it? But the whole question is a little jumbled up, so it's fine. Even if you want to skip this question entirely, that's also okay. But that's how they are trying to get it. All right. What is the amount of preference dividend to be reduced from P&L for calculating basic EPS? So preference shares ka basic EPS, how do you calculate? Sir, for basic EPS, we want each earnings attributable to equity shareholders or earnings available to equity shareholders. How do you get that? From profit after tax, we need to deduct preference dividend. Yes. So for that, there is a small concept. What does our concept say? So you need to check whether the preference shares are cumulative or non-cumulative. Cumulative preference shares means the dividend goes on accumulating. Meaning if this year, if the company makes loss, this year you will not pay any dividend, but the next year when company makes profit or whenever in future company makes profit, all the previous year dividend arrears also has to be settled. Meaning dividend goes on getting accumulated. So company cannot escape from that. So what our, basic EPS ka standard says, the standard says is, if it is cumulative preference shares, then preference dividend has to be deducted. If preference shares are cumulative, then preference shares has to be deducted whether it is declared or not. In the current year, whether you have declared dividend or not, irrespective of that, you have to compulsorily deduct it. This is for cumulative. However, if it is non-cumulative preference shares, you will deduct preference dividend for calculating basic EPS only if the dividend is declared. All this we have applied. Since these are cumulative, we need to check over here what sort of preference shares are these. Check adjustment number 3. They said cumulative preference shares. Okay. They said cumulative preference shares. So I only will read the current year. So current year, what is the arrears of dividend? 1.75. So the dividend pertaining to current year is 1.75. Since it's a cumulative preference shares, for the current year, when you're calculating basic EPS, this 1.75 will be compulsorily deducted. Whether the company pays it or doesn't declare it does not matter. Whether they declare, pay and all is irrelevant. If it is cumulative, then that year ka dividend has to be compulsorily reduced for basic EPS wala calculation. That's about it. Then they're asking you what will be shown as an inflow in respect of earnings from associate for cash flow statement. Okay, next they have given a cash flow statement I think some data. Point number 4 we'll read. On January 20x3, U Limited acquired 30% shares in T Limited. So T is our associate. Investment was accounted as an associate in consolidated financial statement. Both U and T have an accounting year 31st March 2023. Okay, fine. All right. Net profit of the associate company is 0.023 crores. It should be okay. And that associate company declared and paid a dividend of 0.1. Now, sir, they're not asking you the investment value as per equity method. If they ask investment balance, what we would have done? If associate company reports profit, we will record our share of profit by increasing the investment. If associate company declares and pays the dividend, then we will reduce the investment value. They're not asking investment value. They're saying in cash flow statement what you'll do. Sir, in cash flow statement, will you get this profit? No, profit is an equity. It's a bookish adjustment required as per equity method. In cash flow statement, we want only cash coming in and cash going out. If associate company pays the dividend, means you as an investor, you will receive not full dividend, but only your share. That only will come in cash flow statement. No. So total dividend declared is 0.1 and we own 30% share. So 0.1 ka 30% you do. That is the dividend received. Dividend received is an income. So that's what you will show in your cash flow statement. That's what they asked. Then they asked amount of goodwill on acquisition of S Limited. I think they've given one more case. Separate case they are. Sometimes, sir, all the case may be one case spread across in different para. Or they may give you different small independent cases. And based on that, they can ask MCQ. The way study material or ICAI wants to ask the question is totally their choice. But in my opinion, the case will be around the concept we have learnt. Okay, at least majority of them. One or two you may get here and there as a bouncer, little tricky. That is usually expected in CA curriculum and CA exams. But majorly I'm expecting the questions to be straightforward. So, but just take a little time. Okay, just don't be in a too much hurry. Now I've read the data once, so I know what the gist is. So I'm just directly diving into the relevant content and telling you because I know that many of you have a time constraint. So I don't want to take so much time to solve each and every case because it's a waste of time for you also. Because none of these are new, right? Even if I don't do this, as I told you initially, you can still manage this. So in the interest of time, I'm trying to speed up this process. Okay. But in examination, read every line. Don't directly skip off the things because one word here and there can change the whole answer. And read the requirement properly. Okay. See, the moment you read associate, we have done so many questions as per equity method that then our mind will automatically go towards calculating the carrying amount of investment at year end. But they're not asking that. They ask you how much will you show in cash flow statement. In cash flow statement, only dividend received data will be captured, nothing else. So like that, you need to be a little careful. Yeah, what they've asked. Okay, next they've asked the goodwill with respect to acquisition. U Limited acquired 60% stake in S Limited, separate case study. With 60% we got control. Cash consideration payable is 1 crore, great. 1.21 crore after 2 years. So there is a cash consideration immediately and there is a deferred consideration also. Okay. The cost of capital is 10%. So find out the present value. 0.9090 is first year ka discount factor, 0.8264. So 1.21 into 0.8264 you do that is second year ka discount factor. You will get present value of deferred consideration. Cash you paid 1 crore. Present value of deferred consideration also ironically is 1 crore only. So total PC is 2 crore. Okay. All right. Next, fair value of net assets is 3 crore. Net assets, what we have to do? Reduce it. So reduce net assets. Then we need NCI. How they told NCI? NCI is measured under PSNA basis. They're asking. Total net asset is 3 crore. As a parent, we own 60%. So NCI ka share is 40%. So 3 crore ka 40%. NCI will be 1.2 crore. These two addition, net asset reduction will give you goodwill of 0.2 crore or 20 lakhs. So here they've given the goodwill as 20 lakhs. So that is the option. Straightforward question. Okay. I think we have one last case study. Yeah. All right. I think there's also an MTP question only. So some multinational companies there, it seems. Okay. Again, I probably will quickly run through what they're asking. With respect to H Limited, state whether the error. Okay. This is an Ind AS 8 question. Error may what you have to do. Okay. Error, you know, sir. What is it? If you have committed in the current year, adjusted in the current year financial statement itself. If you have done it in the previous year, then anyway presenting the previous year financial statement, you can correct that. However, if error relates to a period before previous year, then what you have to do? Normal error means you have to prepare what's a opening. We normally prepare third balance sheet. We used to say yes. You have to prepare one more balance sheet and then you have to adjust it. However, if it's a date of transition, if it's an Ind AS 101, first time if you're moving to any Ind AS, thereby if you have done any error means, then on first time when you move to Ind AS, you have to prepare a balance sheet on date of transition. Instead of third balance sheet on Ind AS 101, we call it as date of transition ka balance sheet. There you will adjust it. Okay, let's see. In that context, maybe this particular question may relate to. I don't know. Then they're asked how many performance obligation. Ind AS 115 ka question. Gain in sale of what is the amount of gain on sale of interest in subsidiary? So we have sold some stake in subsidiary. So they're asking some gain or loss there. Okay, we'll figure it out. Now let's come back to the case. Main company is G Limited. H Limited is one of the recently acquired Indian subsidiary of G Limited. Okay, one subsidiary we have acquired. It has to adopt Ind AS for the first time. Okay, this is the first time adoption. Okay, and first time we are adopting Ind AS on 31st March 20x4. So current year is 1st April 20x3 to 31st March 20x4. We not only have to give current year data but also previous year data. So previous year will be 1st April 20x2 to 31st March 20x3. Not only that, first time when you're adopting Ind AS, you have to also prepare a date of transition ka balance sheet, which is 1st April 20x2. Okay, all right. With 1st April 20x2 as a date of transition, great. As of 31st March 20x2, the value of raw material was incorrectly reported due to an error. Okay, there was an error. Okay, all right. Excuse me. That error is on which date? 31st March 20x2. 31st March 20x2. Does it relate to current year? No. Does it relate to previous year? No. Previous year starts from 1st April 20x2. You committed an error before previous year. So if any error relates to a period before previous year, all that error adjustment has to be done on, or its effect has to be given in date of transition ka balance sheet. That's what you need to tell over here. So that's what the option is. First option says corrected in the current year. Current year, no, you can't correct it. So what is the correct option? You can't correct it in the current year or comparative previous year financial statement, but you have to adjust it in date of transition wala balance sheet. The first India's financial statement shall distinguish the correction of errors from the changes in accounting policy and reported as part of reconciliation on 1st April 20x2. Yes, because on 1st April 20x2 you prepare a balance sheet, date of transition ka balance sheet. So here you need to adjust. That's what you need to select. Theory question. Okay. Now they asked how many performance obligations. Separate case study. Second case study they've given. Let's run through that. G is engaged in software development. It also enters into a contract with a customer to transfer a software license, perform installation service, some software updates we are giving, and technical support. Same question is there in our class notes and study material also. 4 promises. Performance obligation means it's a promise made in the contract with the customer to transfer a distinct goods or service or series of distinct goods or service which has a similar transfer pattern to the customer. That's what we said. Okay. And when can you say goods or service are distinct? When it can be used on its own or with the resources available with the lessee or the party or with the customer, and the goods are not highly interrelated or interdependent. That's what I told you. All right. That's the actual definition of performance obligation. Or in layman terms, performance obligation simply means promise. How many promises? So here it looks like 4 promises. No. License is one, installation is one, updates is another one, technical support is another one. But sir, if all of them are highly interrelated or interdependent, then all the 4 will become one. That's what we mean by, for you to call it as distinct goods or services, each service should be separate. It should not be highly interconnected or interdependent. So let's go through that. G Limited, the company, they sells license and installation technical support separately. Oh, okay. It is different. Because we give, it's not necessary that all the 3 has to go hand in hand. We also sell them separately also. So if customer wants, he can only buy one and not buy the other 2. Or he can buy 2 and opt not to buy the other one. Like this, any permutation combination customer can choose. So it is sold separately. So it is not highly interrelated. We can make out. The installation service includes changing web screen, and installation service is routinely performed by other entities and does not significantly modify the software. So it's not necessary that the customer has to take installation of software from us only. Some other vendor also gives it and he can take it, is what we're saying. So that means what it is, not highly interrelated or interdependent. Software remains functional without updates and support also. Okay. So all these are not also highly interrelated. Sometimes they say if software works only due to technical support, then they are highly interrelated. In this case, software can function independently. So how many performance obligation? There are 4 performance obligation in this particular case study. Yeah, that's what it is. I mean, which one? License is one, installation is another one, updates is another one, and technical support. Those are the 4 different performance obligation. That's what they asked. Okay, next, G Limited sells 20% interest in wholly owned subsidiary. Wholly owned subsidiary means G has 100% stake in K. In that they sold only 20%. So loss of control. No. With 100% we had, 20% we have sold. So we still have 80%. So this is not a loss of control accounting. Okay. This is a transaction between equity participants is what we used to say. Yes. So gain or loss arising with respect to equity participants, we have to account it in other equity only, because we have a thumb rule. Anything related to equity will never see the face of P&L. Anything related to equity will stay in equity only. Yeah. All right. So we sold 20% for 100 lakh rupees. Okay. For outside investors. Outside investors here refers to NCA. Because if we sell 20% means NCA ka balance will increase. Earlier there was no NCA. Now NCA has 20%. So NCA ka balance will increase. So what is the journal entry? Bank account debit 100 lakh. We sold it. Now we have to record NCA. NCA will obviously come on the debit credit side. On the liability side. So to NCI you will say. What is NCI? NCI is a shareholder. Shareholders ask for what in the company? If you are an equity shareholder, your entitlement is towards the net assets. Yes. By owning equity shares of one company, you have a right over that company ka net assets. So on this date of sale, do you know net assets? Yeah, the carrying amount of net assets of this company was 100 lakh, including goodwill. Fine. It should include entire value. So total net asset is 300 lakh. How much stake did you sell? 20%. So NCI has a 20% claim on this net assets now. So 300 ka 20% is how much? 60 lakh. So it's like telling 60 lakh is the worth of the investment. Because total worth of the company is 300 lakh. Okay. 20% only you sold. That means the worth is what, sir? The worth of the investment sold is only 60. But you sold it for 100 lakh. That means the parent made a gain over here. So 40 lakh rupees is a gain. That gain will be transferred off to other equity because it's a transaction between equity participants, right? One equity participant, the parent, is transacting with another equity participant, that is NCA. So any transaction between equity participants will never be accounted in SPL. It will always be accounted in other equity only. So that is what they asked over here. What is the gain to be recorded? Gain you recorded is 40 lakh rupees. That's all. Okay. So yeah, with this, all the MCQ based case studies also we have completed. Hope the session was helpful to you. Wish you all the very best. Take care.